This is buying a Norwegian rival for 12.9 billion kroner, Guy.
Okay, here we go. Time for the opening trade. Let's take a look at where we are going to be here in Europe this Thursday morning. We're anticipating a negative open. I suspect that's what we're going to get straight out of the gate for the FTSE 100. It is losing ground fairly rapidly as we start getting going with more stocks opening up. So we're down 2.3%. I think that probably accelerates to a 1% move. The IBEX is already down by 1.5% this morning. Where does this get priced the most? Are we going to see the names that have benefited from having US exposure getting hit the hardest here in Europe this morning, or is it a broader trade? Is there an FX factor that we need to roll into this story as well? Remember, the euro has lost significantly against the dollar as a result of the move we saw yesterday from the Fed. It's really interesting. The CAC's down by 1.3%, FTSE's down by 1%, 600's down by 1%, IBEX is down by 1.44, let's call it 1.5%. I'm really intrigued to see what the DAX does this morning. In so many ways, it's at the epicenter of the European story this morning. The car story is front and center there. But you've also got names like SAP, which have really driven that market so strongly. Does it have an effect from what we saw yesterday in the NASDAQ? I think that's going to be interesting. Critty, what are you seeing?
Well, the sensational six, your sensational six, not very sensational today. They are the weights on the stock 600 this morning from an index contribution perspective, right on your screen across the board for the majority of it. I'm looking at only 17 stocks out of 600 in positive territory at the moment. And again, your biggest downside movers, Anna, from a weighting perspective is ASML, Schneider Electric, Novo Nordisk, and LVMH.
Feels fairly indiscriminate, doesn't it? When you look at all of the sectors in negative territory, every sector losing more than 0.3%. So even the more resilient side is down. Technology is the weakest performer. And to your point, Critty, earlier on, it does seem as if we're seeing some read across, perhaps from the Micron story, into some of the players in the tech space, because it is that more traditional PC and phone story that reads better into Europe, reads more cleanly into Europe than the AI thing.
Do you think it's the Micron story? This feels like you look at ASML, you look at Schneider, SAP's down as well, Novo's down. It's the names that have got US exposure. It's the names that have done better recently off the back of the fact that they have huge businesses over in the United States. SAP has driven the DAX this year. It is down by 1.2% already this morning. ASML is down by 2.5%. Maybe that's the Micron story. But these are all names that have been at the center of the concentration story here in Europe. And those are the names, therefore, you could argue maybe have done better off being kind of with having a US kind of flavor to them rather than maybe a European flavor to them. Schneider maybe feels that kind of way as well. But it's interesting. It's ASML, Schneider Electric, Novo Nordisk, Asia Brand Bavaria, Siemens, UBS is down a little bit, LVMH and SAP.
It's also, I think, worth saying, you mentioned that U.S. exposure, but the ripple effect of that dollar move, for example, is going to be on Latin America, on EM currencies. You look at all the Spanish banks that are exposed to that have really been hit by the Trump trade as well. That takes a hit. And then, of course, that doesn't even start with the bond market.
Yeah, looking at the opening of the gilts market, UK bonds slumping at the open, 10-year yields rising by 9 basis points. And Critty, you were making the point before the break that we saw movement across, and this is, of course, as we're waiting for the Bank of England, but this does seem to be a pan-European move. I'm looking at Italy up 8 basis points, Spain up 7 basis points, The UK moving with the Eurozone periphery, it would seem. France and Germany up by 5-6 basis points. So it's everywhere, but more pronounced in the UK and in Spain and Italy as we factor in some of the moves that we saw in bond markets over in the United States. That global narrative around we're just not going to get as many cuts as we thought months ago.
So the mood today, sell first, ask questions later, seems to be the question. John Milton, head of global multi-asset strategy at JP Morgan Asset Management, joins us around the table. John, is that a fair assessment of the market moves, or is this simply just processing yesterday's turmoil?
Well, we came a long way, didn't we, in just over a month, if we think about the moves we've seen. And we got quite exuberant at one stage. And frankly, I think yesterday the Fed did a bit of a mark-to-market exercise. It basically said, OK, guys, you got very exuberant about how much we're going to cut rates. But you know what? Inflation's still something we care about. The economic picture looks pretty strong in the US. And the market, I think, has gone through a repricing exercise. Jay Powell yesterday actually admitted that some of the staffers in the Fed have started to calibrate a little bit in their expectations for what may or may not happen next year as the new administration takes hold in January. Yeah. So I think what we've seen really is just a little bit of cold water poured on what is otherwise a decent economy. And I'm constructive about next year, and we're positioned accordingly. But trees don't grow to the sky. And this is one of those situations where the market perhaps have gotten a little bit ahead of itself. And, if I'm a bull, I've got to love a healthy pullback.
I love that you just said that. I have so many follow-ups. John,
I'm asking myself why they don't grow to the sky. But anyway, that's for a different show. It is entirely different.
We're Christmas Friday energy here on a Thursday. But John, what I think surprised me, and call me crazy, but I think what surprised me by the market reaction yesterday off the Fed is how baked into that bull market the Fed cuts were, especially when we're talking about a background of economic resilience, a background where Donald Trump's policies come from a position of strength that at the end of the day could benefit Americans who have the ability to digest a little bit more inflation, something that other global citizens don't have that. So in that context, why would a bull market really need Fed cuts baked into it to keep rallying?
Well, this is exactly the point. So, bear in mind, when you think about the basic Finance 101, your discounting rate goes up, then your present value goes down. So you've got to do a bit of a reset one way or another. But you're absolutely right. Equities, generate their earnings out of the nominal growth picture. You've got core CPI running at 3.3. You've got GDP now running about 3.2. This is a very healthy, strong economy right now. And we're expecting decent earnings growth across the index next year. The crucial thing is we're actually seeing it broadening away from those big tech names that we've seen really lead the rally this year. Doesn't mean that they're going suddenly into reverse, but it's just widening out. So I think what the market is starting to do is price, number one, a bit of uncertainty around the trajectory of inflation, which we heard from the Fed yesterday, will be a little bit shallower. They're not going to hit their 2% target until probably 2027. So the level of rates that they can cut to is obviously commensurately higher. That follows through. But the underlying picture on the US economy is one of decent nominal growth, and that's what's going to drive earnings.
And we've seen this, so the rethinking where rates go, it had a pullback effect on stocks in the States, and that's to be expected. There's a bit of read across into the European trade as well. We didn't go as high, but we're pulling back a little bit, down by 1.3% today. Where does that leave your expectations for Europe? Yesterday we had a guest on who was talking about actually a couple of things could change on Europe that could really change the narrative, could act as catalysts. One of them could be peace in Ukraine.
Yes.
Whatever that might look like, we'll leave that for another conversation. And another might be what a new government in Germany will do. Do you have any expectation that these factors change the outlook for Europe?
Well, I've been covering Europe for long enough to be used to being disappointed sometimes. But one thing I will concede is that the Eurozone tend to do quite well when there's a crisis. When they really need to get something together and actually change direction, they can move reasonably quickly. The issue that you often have is that we have to build a lot of consensus within the Eurozone. So you're right, the catalyst in Germany on the 23rd of February is a significant one. But it'll take a while to form a coalition. It will then take a while to decide how to actually move away from things like the debt brake, the black zero policy. And we've heard Merz coming out and saying, that's not on the table right now. So the idea that we get a sudden reset in terms of fiscal support in the Eurozone, and there is dry powder through the Next Gen Fund, make no mistake, that could be a little while yet. But Europe is certainly pricing inexpensively if you look at it relative to the US, but it's worth bearing in mind the Eurostoxx is trading at around 14.5 times PE. That's half a turn below its sort of long-term peak. So it's not actually cheap internally.
Are the factors I cited, Ukraine and Germany, and the fiscal impact that might have, are they enough to change the narrative on Europe, or do you need something else? Because there's a lot of talk about, just structurally Europe isn't set up for the new tech era, for example. Do we need something else?
Well, I'm not sure. I think there's a couple of things to consider. Look, Europe doesn't have a solvency problem anymore. Certainly not that we can see. It has a growth problem. It's an aging economy that's had very little sort of impetus onto its consumers. The European consumer just doesn't, unlike its European US counterpart. So you don't have that big sort of boost. And secondly, global growth has been a problem in the goods market. So we've seen that slow down. You see that in the difference between services and goods inflation. So without that, and with a block which is geared very much to the goods economy, it's going to be slower. But make no mistake, and we all pray for this over the holidays, I'm sure, which is that we get a peace in Ukraine. That will remove a major left tail risk. And under that circumstance, you can see a significant repricing of risk, but it doesn't go anywhere to addressing Europe's underlying growth problem. That's going to take some fiscal involvement and a little bit of impetus from governments really getting their heads together.
Can I kind of fold that into a conversation around the S&P and the equal weight? In theory, you'd have expected the equal weight to do better, i.e. you'd see money coming out of tech stocks, and as a result of which the equal weight would outperform the S&P. That didn't happen yesterday. In fact, it hasn't been happening for a while. This whole idea that we're going to get this broadening market has been sort of blown up over the last few weeks. Why does that trend reassert itself? And if that trend does reassert itself, does Europe get any of the crumbs from the table as a result of that?
So I think we've got to look at the whole context. I mean, we did have a big outperformance of small and mid, and it's basically given it all back as we've repriced the rates. So we're not in any worse position. I think what we saw yesterday was a de-risking event.
Sure.
And so, we're coming into a thin time of the year. We've got triple witching on Friday. After that, markets are going to be thin. If you want to be out, this is the time to do it. So, to my mind, this feels like a sell-off of some exuberance. But a couple of things I'd say. First and foremost, if we look at the sort of likely pathway of fiscal support, tax cuts, potentially the issues with some deregulation, that leans more to the small and mid-cap area. And so we like broadening out. We think that's a theme for next year. The second thing I would argue...
Why didn't it work this year?
Well,
because I heard that commentary earlier on this year. We're going to broaden out. The market's going to broaden out. That's what's going to happen. It happened and then faded really quickly. A lot of people got burned. Why are you more convinced that it happens next year than it would have done this year?
Well, I think a few things. I think if you look at the sectoral mix, I mean, what's been rewarded in the US has been quality. You've had quality earnings from the big tech firms. That's been rewarded in what was an uncertain environment as we were going through a Fed reset. You didn't have necessarily the same growth stimulus that's coming through, even though we've had a very strong...
But we're going to see huge amounts of uncertainty next year. Why wouldn't I just sit in big tech?
Because I think you're getting a very strong pickup in terms of the fiscal impulse that's expected to come through. You're getting much more sort of inward-looking policy, which I think supports some of those firms. So you're getting a situation where I think you've got some more certainty, some broadening out, some extension of the cycle. So that together, I think, gives you a reasonable support for small and mid. This is not a world where we're thinking that we see the big caps and the tech firms suddenly go into reverse. I'll give you an example. This last year, we've seen 40% earnings growth in the Mag 6 firms. Next year, we think we'll see 22%. This year, in the other 494, we saw 3% earnings growth. Next year, consensus is expecting 13, and that's because of a broadening out, a pickup in the goods economy, reacceleration in the housing market, etc. So all things which will benefit the broader economy, not just those high-quality cash compounders, which, frankly, are what the big tech firms are.
Great to see you, John. Have a great new year.
See you too.
Thank you very much indeed, and a happy Christmas as well. John Bilton, Head of Global Multi-Asset Strategy at JP Morgan Asset Management. As was pointed out a little bit earlier on, the Core 6 is not looking very clever this morning. Let's take a look at what the numbers look like. As you can see, it is a sea of red out there. Even the relative safety of Nestlé this morning is seeing some downside. But as you can see, big cap tech in Europe, the kind of core of the market, is certainly under significant pressure. What else are we watching? Joe Easton has the details.
Going to start in the tech stocks, Guy, and as you say, not looking too clever, that you could say about these chip stocks. Seeing some real weakness in the smaller names, particularly Eichstrong, also VAT Infineon as well. Now remember, it's a double hit from the Fed and also that warning from Micron. That stock dropping around 16% in US trading and weighing on the stocks in Europe as well today. Then in terms of pharmaceuticals, two stories going on there. Firstly, Roche declining after that Parkinson's disease drug trial that did miss primary endpoints, according to a statement. We're seeing the stock coming down 2%. That drug does have 2.5 billion in estimated peak sales, but it was seen as high risk for that one. But another pharma stock going the opposite way entirely is BioArctic, absolutely soaring over in the Nordics today, up 29% at the moment. The company has announced a pact with Bristol Myers Squibb on one of their antibody treatments in the US, getting a big payment in terms of some milestone payments that could top around $1 billion, according to a statement on that one. Then in terms of software, we have got that M&A Software One buying Crayon. Now Crayon, seeing that one a little bit lower this morning, to potentially we're waiting for the move to come through in that one. But Software One actually bucking the trend of the downturn in tech this morning. Investors getting excited about the potential benefit of this M&A, so that one going higher. Then closer to home in terms of the UK water stocks getting a boost because Ofwat has announced the amount of money that can be charged for water bills. Not good news for all of us that have to pay water bills, of course. But in terms of the stocks, they're going higher. Severn Trent and Pennant, actually a couple of the best performing stocks on the entire Stocks Europe 600 today. Kind of tell you how many stocks are negative given the moves from the Fed. Then in terms of rating changes, UBS has a big note out on insurance today, and they've downgraded a couple of stocks. They put a sell on Zurich, which is an unusual rating for that company. This is all due to valuation. The positivity around insurance premiums is factored into the price, and that one is declining 1.7% this morning.
Joe, thank you. Joe Easton from our equities team with a briefing on those stocks that are moving. We are watching live pictures coming to us from Brussels. EU leaders are busy arriving in Brussels for a summit that is taking place there. We've seen Ursula von der Leyen arrive, Viktor Orban arrive. We just saw the Greek Prime Minister Mitsotakis getting out of his car as well. So we know they are on their way. We will be in Brussels shortly. Oliver Crook live from that EU Leaders Summit next. This is Bloomberg.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything. Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything. The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space. That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
From the beating heart of global finance, economics, and politics,
and wherever newsmakers are moving markets. Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Get your fixed income fix. Half an hour dedicated to fixed income. Watch Bloomberg Real Yield. Context changes everything.
Let's call it 19 minutes into the equity market session. This is what equities in Europe look like. This is what the indices look like. We are down across the board. London maybe getting a little bit better, but most markets are down by, let's call it 1.3%, looking a bit better maybe. Technology, financial services, real estate, the three big sector losers. You certainly saw real estate under pressure over in the United States yesterday. If you're looking for some safety, you find it in groceries this morning and in the food and beverage sector. But even the food and beverage sector is down by 0.7%. Every single sector in Europe is under pressure. Alice Weidel is the first ever Chancellor candidate from the far-right Alternative for Germany party. Let's move on to German politics. The party is currently second in the polls ahead of the country's elections, which are now taking place in February. In an exclusive interview with Bloomberg's Oliver Crook, she slammed the EU for undermining the country's auto industry and calling for a German exit from the bloc.
We don't see that the European Union in its current state is an institution that is working well, right? So what we need to have is free trade among the European countries, but we don't need all the bureaucracy. So example, the European Commission, which is actually not voted, right? So you have a executive power like the Commission with also legislative power. That is not elected. So this is a huge democratic deficit. So this commission decided just to forbid diesel and benzene, like all the traditional fossil motor, right? So what happens is that they actually ripped off the German automotive sector.
Many people are critical of the EU on many of the points that you make here, but very few are making the case for withdrawal from the EU, and specifically on the euro. How do you envision that happening? Was it a return in Germany to the Deutschmark? Is it then? Explain to us the mechanics of how you imagine that working if you had your way.
Well, this is the entire discussion around the Dexit, right? Yeah. So we think that the European treaties need to be reformed so that every country within the European Union has a right, first of all, to have a veto against the Commission. For instance, that the German government could say, okay, we don't agree, we say no. Mm-hmm. So the veto power in the European treaties. And if a country wants to leave the European Union, why not falling automatically into a free trade zone? I highly recommend just a free trade zone because all the bureaucrats, thousands of them, like eating up taxpayers' money, they just disturb real competition among the European countries. We don't need all of these bureaucrats that have actually who have no clue what they're doing and destroying our foundation in the European Union.
The view from the AFD. Interesting line, given what happened with Brexit and the kind of hard Brexit that ultimately was delivered. Let's turn our attention back to the EU Leaders Summit, which is taking place in Brussels. We've been seeing some arrivals over the last few minutes. Ollie is there for that as well. Ollie, what are we looking for?
Yeah, so listen, Guy, I think it's really interesting to talk about that sort of interview with the AFD in the context of what European leaders are dealing with here in Brussels. I mean, the AFD, again, is one of these far-right parties in Germany. Many of the far-right parties, like Le Pen, have abandoned this idea of exiting the euro, of exiting the EU in order to become more palatable and gaining sort of presence and political power. The reality of the situation is the AfD will not have direct political power because they will not be able to join a coalition. They've been boycotted from everybody in the German establishment. But as the #2 party in Germany, arguably the #1 country of the EU, for this conversation to be present is something that just is added to the list for European leaders to worry about here. And at the top of the list for European leaders, I say there's really 3 big issues. I think the first one is the elephant in the room, which is basically the dysfunction within Germany, within France, and the difficulty of getting anything done in that context, particularly at a time when you need immense political will in order to enact the Draghi agenda. The other question is, of course, Ukraine. We're waiting for Zelensky to walk in any minute now. I'm speaking to European leaders. But again, on this issue, there's very much a sense that basically the Europeans are kind of paying for some of the gas, but they are not driving the car. And that comes to the third issue, which is really Donald Trump. This is the final meeting before the inauguration of Donald Trump in January of next year. So the question is, how much Trump-proofing is there going to be going on behind the scenes? I spoke to the Luxembourg Prime Minister about this yesterday, and really, frankly, all the leaders I've spoken to have been very reticent to have any sort of opinion on Trump, very much wait and see. But the reality of the situation is there's a sense here that this is an EU really in the back seat, and they really need to sort of come together after they have sort of resolved many of their own political domestic issues, which, frankly, we don't see happening anytime soon.
Okay, Oliver, thank you. Bloomberg's Oliver Crook there. Now, clearly, defence part of the conversation. This takes us on to our next discussion. NATO Chief Mark Rutte is calling on allies to ramp up defence spending to prevent a future war with Russia.
We are not ready for what is coming our way in 4 to 5 years. We can prevent the next big war on NATO territory and preserve our way of life. This requires us all to be faster and fiercer. It is time to shift to a wartime mindset and turbocharge our defense production and defense spending. Russia is preparing for long-term confrontation with Ukraine and with us.
Some of the words we've heard recently from Mark Rutte. Bloomberg Economics and Government Editor Tony Halpin joins us now, and I know we put some spotlight on this story at Bloomberg News today, Tony. How are European leaders then responding to what they see as an increasingly serious security threat from Russia as they gather in Brussels?
Yes, it's a very mixed picture because many European leaders in the east of the continent have been warning for some time that the threat from Russia is rising, and some of their complaints towards their Western European colleagues is that they're not taking that threat seriously enough. As you just heard, though, NATO is now warning very clearly that European governments need to do more. They need to respond to what's viewed as a campaign of hybrid attacks, sabotage, interference in elections that are intended to undermine confidence in the governments of Europe and to undermine European efforts to defend themselves against what is seen now as an aggressive Putin regime, battle-hardened and with a war economy that's churning out vast amounts of armaments.
All right, Bloomberg's Tony Halpin, we thank you so much for walking us through, of course, that crucial story. Russian security and that defense story very much in focus, as, of course, Tony and Oliver both really talking about it. It's also certainly something that's going to be discussed later today when we speak with the U.S. Secretary of State, Antony Blinken, about not only Ukraine and Russia, but the Middle East as well, the foreign policy transition under a second Trump administration when it feels like a lot of people, both on the fiscal side and the monetary side, really standing on the sidelines, waiting to see what those policies look like before acting. Was certainly a theme both in Governor Ueda's comments and, of course, in Jay Powell's comments as well. We'll likely see that in the BOE. That interview coming up at 1:15 p.m. London time. Stick with us. This is Bloomberg.
You missed it on Bloomberg, the China show. What's been the sentiment? What's been the reaction to this U.S. election outcome on the ground?
They were pretty much ready for Donald Trump. There was a high expectation that he could return to the White House. We have dealt with him before, and after quite a few years, China simply is better prepared, and China, psychologically speaking, is much more prepared in dealing with him again.
Probably are fully prepared for Trump to impose higher tariffs on China.
What's the tone as they were talking to really a global investment?
Right. The openness of China, including the capital markets, Hong Kong being an international financial center will be extremely important in channeling global investors.
Don't miss the China Show live every weekday.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg's covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
Or other authorities.
Could face bigger challenges next.
It was going to keep reading World Cup. This is a 3.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
And we are getting breaking news from the Riksbank out of Sweden. They are cutting their policy rate to 2.5%. The estimate was 2.5% as well, cutting by about 25 basis points. This is their 5th rate cut this year. Not a ton of movement in the Swedish krona against the euro or against the Norwegian krona as well. The crucial bit here is that Sweden is viewed as the major Western economy with the least amount of purchasing power. So those currency moves are going to be crucial, but perhaps already baked in. We're also 30 minutes away from the Norges Bank decision as well. Simply this idea they are the most hawkish outside of the BOJ. I think this is a fascinating one to be watching because they kind of have their hands tied. They don't really know how to stimulate the economy.
Yeah, this was one of the central banks, and there weren't many that we were waiting for actually deliver a cut this week, and they have done, just as the Fed has done. But they are also giving some guidance on 2025, and they say they may be a cut once again in the first half of 2025, so a little bit more guidance there. They see risks linked to economic recovery and also around the krona rate. And we saw just yesterday the government actually downgrading their growth estimates for the Swedish economy.
But they're doing the same thing. So for 2025, they've downgraded the estimate from 1.9 to 1.8%. So that's the GDP growth target for next year. 26, they've upgraded it a little bit. So they're pushing that growth story out a little bit further on. Not much reaction in the currency, as you say, maybe one more cut coming. Are they done at that point? Is that as far as they ultimately need to go? This feels very priced in terms of the narrative, and as you say, we've already seen a front running of the GDP forecast changes coming out of the government.
And it feels very priced. And Chrissy, we're watching a tale of two Scandinavian banks today, aren't we? Because this priced and what is priced for 9 o'clock in a half an hour's time is for the Norges Bank to do nothing, and that seems to be something that we're also widely expecting.
Widely expecting that, but also watching some of the M&A front as well. And I make that connection simply because on the one side, you have these policy decisions that could change the financing rates for some of the M&A stories in Europe.
Does Volkswagen benefit from a weaker euro? Is that a story that could help it ultimately next year? Or is its geographical footprint so big that actually its currency hedged just physically as it works its way around the world with the number of plants that it's got. Germany is the focus of attention, though, right now, and Bloomberg has learned that Volkswagen and its Labour leaders are moving closer to a deal, maybe to restructure the automaker's namesake brand without shuttering factories in Germany. Let's get some analysis on what is happening here and what the wider implications are. Bloomberg's Craig Trudell leads our Autos team. Patrick Hummel, head of Autos European Research at UBS, joining us around the table and also down the line. Craig, I want to start with you, first of all, just to bring us up to speed with where we are with the news surrounding this Volkswagen deal with unions. How close are we? What does it encompass?
Yeah, this was a scoop overnight from Monica Raymond in our Berlin office. This has been dragging on for weeks now, this attempt on the part of management to really significantly restructure their namesake brand. This is years in the making in terms of structural inefficiencies, overcapacity. We've seen time and again Volkswagen try to rationalize, really make efforts to bring some costs down. What they've repeatedly run up against, of course, is the structural challenges that they have with the labor position, sort of left, right, and center, really being a bulwark against having to make tough decisions. And so what we're hearing is that there may be some give in terms of what workers are willing to give up in order to keep plants open.
Patrick, let me come to you. We've seen the European data this morning in terms of auto sales. It continues to look fairly grim. Let's figure out whether or not Volkswagen is going far enough. Is a deal with the unions in Germany to keep Germany open, to not see factory closures, the right way to go for this business?
Lukewarm to us, to be honest, what we've been reading overnight. And we're not sure this is really the final package, and this is something management can agree on. Just forgoing bonuses and keeping all plants open, reshuffling product a little bit, that's not saving you 4 billion euros a year, but that's the number the company needs to at least get closer to the margin targets. And there are lots of headwinds. It's the weak demand situation, as you rightly mentioned. The European CO2 compliance framework is a headwind for the company. So we don't think the measures that were mentioned overnight in your article are going to be sufficient to get to the 4 billion savings.
So that's interesting. So yeah, to the point you were making, Craig, this is sort of a step on the way, but as we were just hearing there, maybe not the final final arrival point for VW. We've had a lot about consolidation, and we talked yesterday about Japan. A lot about consolidation this week. We talked about the news from the Japanese automakers, and then overnight this develops even further. Foxconn in talks with Renault to perhaps buy their share of the Japanese automaker. How is this developing? How more likely or less likely does consolidation in the Japanese space look now?
I think this is a fascinating story. With Renault, of course, they have a significant stake in Nissan, almost 40%. Some of that is held up in a trust, just to add a little bit of further complexity to the matter, where Nissan has the right of first refusal if and when there's further selling down of that stake. But if you're in Renault's position, of course, you want the best value for those shares. And so, these reports just in the last, day and a half, that not only is Honda interested in potentially merging with Nissan, but Foxconn also being interested. You want to play that out a little bit. You want to entertain not just Honda, but also Foxconn's interests and get the best value for your stake. I think adding to the intrigue here as well is that at Foxconn you have a senior executive kind of leading their automotive efforts, who is a former Nissan executive, and so there's a lot at play here. And so. There's a lot at play here, and some opportunity for Renault to kind of find an exit for this very substantial stake that is quite depressed because of the challenges that Nissan has been having.
Yes, Patrick, I know European automakers are your focus, but what interests you about these Japanese developments? Is it the fact that Renault gets brought into this very quickly because of the conversations that Foxconn is now having and the stake it holds in Japan? But also, does it set any kind of thoughts running in Europe about further consolidation as a way to take on Chinese and Tesla competition?
All right. First of all, we have to say the Japanese industry is not as consolidated as the European or the North American one in terms of numbers of players in the market. Europe and US are much more concentrated. The immediate interest in that potential Honda-Nissan deal is, of course, from Renault's perspective as a shareholder. Renault is often mentioned as a candidate also for consolidation in a wider context because it's a relatively small player. It's the smallest remaining mass market player in Europe. I can't comment on specific deals or likelihoods or anything, but it's clear that the industry is going through a rough phase. It is an industry that is suffering in terms of margins. Pricing power is eroding. There is new competition emerging, and it's still an industry with a very high capital intensity. So in the end, consolidation is the answer to address these challenges, and let's see how this unfolds.
Well, Patrick, we're talking about wage negotiations as well in the auto space. We're talking about it in the context of Volkswagen. We're talking about it potentially in the context of a merger in Japan if this deal were to come through. It's certainly been a topic over in the States as well. How much of that is the conversation in 2025 when it comes to the bottom line for some of these European automakers?
Right. I mean, first of all, yes, there is a necessity to restructure, and we see lots of headlines on the OEM side, but also numerous tier one suppliers that are in restructuring mode. I think, first of all, the implementation cost of restructuring, especially in Europe and Germany, are quite high. So you better be prepared for significant cash outflows to make these headcount reductions happen or even plant closures. Second, these self-help stories, they take time, but there are lots of headwinds to earnings coming from the pricing environment, the competitive environment. I mentioned CO2, so that, seeing a positive bottom line impact really of the restructuring will take quite a while. And meanwhile, the cash flow situations of these companies won't look great because of the implementation cost of that restructuring. So when we published our outlook for the sector a couple of weeks ago, we painted a quite cautious picture, and the fundamentals are likely to deteriorate, and we find it way too early to say, this is now a sector you can buy just on the restructuring, on the self-help stories.
Yeah. Patrick, we were hearing from the AFD leadership just a few minutes ago. Our colleague Ollie Crook has been talking to them. There is huge pushback from the AFD suggesting that we need to see rules change, that the government isn't supporting the auto sector, that part of the problem the auto sector is having in Germany is down to politicians setting unreasonable targets for the sector to reach. How big a catalyst would it be if we start to have a serious conversation about changing some of those catalysts? Like every month after month, it gets harder and harder to get there. Are we going to have to change the rules ultimately, and when do you think that may come?
Right. The EU, of course, is the main body here. And in the end, there is a new 5-year framework for CO2 compliance that starts on January 1st. That's going to be very tough for the industry to meet. There have been lobbying efforts, obviously, from the industry, also some EU member states that push for a change in the rules. There is a proposal out there that to us looks like a quite possible outcome, which is basically giving the companies more flexibility. They would still have to achieve the CO2 goals over the next 5-year period, 2025 to 2030, but they would not have to be fully compliant in year one during that 5-year period. They could also overcompensate a shortfall next year in the following years, and that would give the industry more flexibility. You would at least avoid the risk of immediate big fines for the industry. You would avoid expensive pooling agreements with companies like Tesla. So in that sense, that would help the industry. But of course, it would not remove the pressure to boost your EV sales, and the EVs are still not as profitable as the combustion engine vehicles. So in that sense, we would still see a dilution of EBIT margins of the OEMs.
So, Patrick, stay with us. Craig, I want to come to you here. He's talking a little bit about the margins and where that wiggle room actually is. Where is it? Given that we're also kind of having a little bit of a race to the bottom in terms of capturing specifically the American consumer as well, where is the wiggle room for some of these car makers?
Yeah, I mean, I don't think there is much, unfortunately, is the sad answer. And when we talk about, I think we led into this conversation talking about, currency and potentially a weaker euro maybe being, reason to lift these companies. On the other side, you have these, countervailing pressures of say a Trump presidency and increasing protectionism and tariffs where, in the past, maybe you could have taken advantage of a weaker currency and shipped more Porsches and Audis to the U.S. market. I don't necessarily see that being, much of an option if the first Trump administration is any guide. When we often heard Donald Trump talk about, lamenting how many Mercedes he sees on Fifth Avenue, and how few Cadillacs and Lincolns we see in Germany or France, and so this is an industry that really is under pressure from a competitive standpoint. I think the rise of China, of course, is bringing so much to this, but also just the fact that we're not seeing, as we've seen again this morning with Europe car sales, we're just not seeing growth, and it's not that sales have fallen through the floor. It's just that we're not going to see a whole lot of upside from here in terms of expansion for this industry.
Craig, I know there's a serious point there about tariffs, but it does make me reflect on the size of some of those American vehicles that you're talking about, whether there's space for them on any of our roads. Patrick, let me come to you finally. Craig talking there about tariffs, and that, of course, as we look at 2025, is a big unknown for many industries, including this one. What do we need to know about those that are cushioned from tariffs because of localized production to a large degree in the United States?
Right. You have, of course, and you mentioned the German luxury car makers, a very large U.S. footprint of BMW and of Mercedes as well. So they look to be more cushioned, as you call it, against tariffs, but they still would import their highest-end vehicles into the U.S., like Mercedes S-Class, BMW 7 Series. These models are still made in Germany and could be subject to tariffs. But clearly, BMW Mercedes would not be as affected as Porsche, that has 100% of its production in the EU. And then we need to see what happens with Mexico and Canada. Obviously, for the time being, I think the market prices it as a tail risk, not as a base case. But also on that front, the European OEMs, the Germans, would not be completely immune. Both Mercedes and BMW do have a Mexican footprint, so does Stellantis. So these are important potential risks that are currently not reflected in earnings estimates.
Thank you very much for joining us. Patrick Hummel, Head of European Autos Research at UBS. We thank you very much for joining us. And Craig Trudell, of course, Bloomberg's Craig Trudell, joining us around the desk here. We have movement in currencies, Critty.
We do. A quick check on dollar yen here. It did hit that 157 mark. Crucially, we started off the day hitting at 150, I think 154 before Governor Ueda started speaking. It was already seeing some pretty substantial moves. The weakness continues, a little bit of a snowballing effect, even though you're seeing strengthening in the other currencies that were hit by that dollar move. Euro dollar at 104, cable at 126, but the pain in the yen does continue. Coming up, we're going to pivot to the UK. Traders looking ahead to the Bank of England's rate decision amid stagflation concerns. We're going to dive into what we can expect next. Stick with us. This is Bloomberg.
DraftKings hit a milestone in the second quarter of 2024. For the first time as a public company, it turned a profit.
Is this a new era for DraftKings?
There's an inflection from when you're cash flow negative and you're operating off of equity raises from the past to when you're self-funded and you're cash flow positive and able to control your destiny a lot more.
You've had your first quarters of profitability now. Does that take pressure off? Does it increase pressure?
I think it increases pressure. I mean, once you start making profits, people expect you to make more, and all of a sudden you're valued on a multiple of those profits as opposed to the theoretical what could be. So very important, I think.
When you're cash flow negative, you've sold a vision of what the company should be working on, and you're very focused on working on that and delivering against that. When you've pivoted to profitability, the world of what you can work on is a little bit open, and there's a lot of different ideas, and it requires more focus than ever to make sure that you are prioritizing on the most important things that are going to deliver the most value.
DraftKings' solid standing in a booming sector gives them the luxury to play the long game. They're not under pressure to cut costs.
When you have really strong revenue growth, you don't need that. If you look at where we are today and where we want to be and where we believe we will be, the vast majority of the incremental EBITDA is not coming from any cost reduction. It's coming from increased revenue.
We don't feel like we need to cut costs because we're growing our revenue so much. We want to grow our revenue into our existing cost structure, and there's no need to reduce the cost as long as we're being efficient with what we allow our cost growth to look like.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Welcome back to the opening trade. We're about 48 minutes into today's session. You're playing a little bit of a catch-up trade in terms of the risk sentiment that we're seeing. We saw a major sell-off in the States. We're seeing a major sell-off here as well, down about 1% on the stock 600, and the other individual indexes across the continent not far behind. Underperformance in France, which continues to be a major theme, and Italy, I should mention, down about 1% as well. We also were seeing a sell-off in the bond market as well. Some of that is being a little bit of a catch-up trade to what we heard from the Federal Reserve, a little bit more of hawkish sentiment there as well. To me, what I think is interesting is that there's also been news out on the fiscal side. Donald Trump talking about merging what was almost a done deal, almost consensus bipartisan bill in Congress to avert a Friday shutdown for the U.S. government, now kind of getting married with the debt ceiling conversation of next month.
What happens if we do see a government shutdown? Like, how do markets react to that? Is this seen as being a sort of tactical story, i.e. Trump comes in and fixes it? Great, we're going to get the deal done at sort of the beginning of next year. How long can it last before we're talking about major damage? Yep. Musk was talking about no damage, virtually no damage coming to the U.S. economy. But that stands in stark contrast to the data that we've seen in past shutdowns, which actually can be meaningful if they last.
Especially, if they last. And this is also at a time of a transition of power as well. Yeah. So you have basically the debt ceiling limit hits January 1st. Janet Yellen has 10 days until the other kind of trigger that happens. It gets a little bit nuanced. She has 10 days to create extraordinary measures, basically, that the Treasury Secretary deploys. It pushes the problem out till July, but then 10 days after that, she's not Treasury Secretary anymore. So Scott Bessent basically inherits this problem, not to mention the government could be shut down the entire time. And to me, what I think is staggering is that we've been paying so much attention to the central bank story in terms of the impact on the bond market. The 30-year is what trades off of the deficit concerns, and that's where perhaps the market isn't pricing in the chaos of the next 48 hours.
Okay, we'll certainly watch to see how this one develops then, Chrissy. In terms of what we're also watching out for today, 12 o'clock UK time, the Bank of England with a rate decision, 1:30 p.m. UK time, US jobless claims. We do have some data. Is anybody in the States still watching, after the Fed decision? I know, Pretty cares. Well, we thought until the end, but actually she's done after this week. So, will you?
It's really you.
Yeah, Guy cares. Next week, Guy cares.
Am I doing your job?
Do I?
FedEx earnings, we get those. Nike earnings, and they are in focus. Well, nice reading on the consumer, nice reading on global trade as well, sometimes out of FedEx. And, some early alarm bells come from that sector on occasion. So always worth watching. And we have Micron numbers, which certainly got our attention overnight. Looking ahead then, the Bank of England stands out as one of the things around lunchtime here in the UK that we have to pay attention to. We're joined around the table by Bloomberg's Valerie Teitel and Dan Hansen, Chief UK Economist at Bloomberg Economics. It's been a busy week for UK data. It's been a busy week for Dan Hansen, who's been here almost every day, I think, talking us through the journey we've been on the UK narrative. So where has that left us then, Dan? We saw actually a pullback in expectations of rate cuts in 2025. From the Bank of England because of the strength of some of the data.
Yeah, we have. We've had this. I mean, it was all on the wage data yesterday. I think there was a bit of consolidation. Obviously, we've had the Fed overnight, but it was all about the wage data and that overshoot. I mean, one thing I'd highlight as well is that CPI overshot the bank's forecast. It didn't overshoot consensus expectations. But I think going into today, and if you sort of take yourself back to what the bank was saying in November and what has been said since, obviously we've had the data of the past week. The bank was looking at the sort of median expectation on the MPC was for 100 basis points over 2025. We're at 50 now in the market. I would be very surprised if the bank came out today and said something vastly different to what they said in November and sticking to the sort of this idea of gradualism. So they tend not to push back against market expectations, particularly when there isn't a press conference, because it can be...
And there isn't today.
And there isn't one today, and it can get misinterpreted when they put it into the minutes. People just get it wrong. But I think there's going to be this sort of tension between what the bank thinks is going to happen over 2025 and what the market thinks is going to happen. And there is definitely going to be...
How divorced is bank thinking from Fed thinking?
It's an interesting one, isn't it? Because we have 50 from the bank this year. We're going to have had 100 from the Fed this year.
Yep.
If next year we have 100 from the bank and 50 from the Fed, if the dot plot's right, N25, they're in the same place. Now, one thing I think I was talking to Fran about this yesterday, that I think the end point of the cycle for both is going to be quite similar, predicated on the idea that the economies don't fall off a cliff, which, you know, we're sort of here in the UK.
Reassuring.
We're here in the UK, we're sort of teetering on the edge, and we feel like we go from quarter to quarter worrying about a recession. But I think the end point, the sort of neutral rate, the Fed's still sort of talking about this 3% number in its long-term projection. It feels like it's going to be quite a bit higher than that to me. And I think both will end up somewhere between probably 3.5 and 4 at the end point for their cycles.
Well, Val, hop on in here, because as Dan was speaking, I'm just looking at the gilt market. You're looking at a 7 basis point move on the 10-year today. Is this simply a little bit of a reaction to what we saw from Chair Powell yesterday and the pretty big move we saw in the Treasury market, or is there something else to it?
No, look, I mean, the gilt market has been trading weak this week. I mean, fixed income globally has been trading very poor in the last 2 weeks. A lot of this reaction in gilts is due to that big rise we saw in the Treasury market yesterday with yields across the curve higher by 11 basis points. I mean, that was all due to the fact that Jerome Powell really put the emphasis squarely back on inflation. The risks tilted to the upside that we saw the members worried about in the SEP projections really, I guess, catching our eye today, just how concerned the Fed is about this uptick in inflation. You guys were just talking about the possible government shutdown and all that confusion that plays into policy coming next year. We know there has been a hit to growth that has come out of previous shutdowns. And Powell spoke specifically yesterday saying policy uncertainty plays into inflation uncertainty in both directions. So a lot of this overhang, you know, it's not going to be gone anytime soon. I know we want to close the books and head up to Christmas break.
I still want some more volatility. I'm not quite done yet, so a bit more news would be good.
Monday, Tuesday?
Monday, Tuesday would be great. Big events on Monday and Tuesday would be fabulous.
Just so we can fill the show. That's always helpful. I mean, Valerie, I mean, looking at the pace of moves in 2025 from the Fed, and to a large degree, all central banks will have to deal with this. Jerome Powell giving us some lovely new metaphors to mess around with. Amidst fog and a room full of furniture, you move pretty slowly. I mean, I don't know which one to go with or which one to go to, but it does sound like a message that lots of central banks will be dealing with, because there is going to be a lot of fog at the beginning of next year.
Yeah, a lot of fog. And this phrase that he used yesterday about entering a new phase of the cycle, his caution around rate cuts coming to the table, is going to get the market to be thinking that we could have a Fed on pause for a substantial amount of time in 2025. And that poses risks, you know, not just to the U.S., but to wider emerging economies. You know, think about Brazil, who's already struggling with their fiscal headroom. If we have a Treasury yield still elevated all of next year, you know, Brazilian government bonds trade at a spread to Treasury. So the fiscal headroom for Brazil erodes even more. You know, perhaps the theme of next year could be EM sovereign defaults.
That would certainly cause some volatility, and in the past has caused the Fed to react. We remember various crises that we've seen in EM feeding through back into the Fed. Dan, is the Bank of England firmly sort of fog-bound at the moment? Should we be hearing warnings blaring across the across the square?
There's always fog, isn't there? And they're paid to look through the fog and work out what's going to happen.
Can you, at this point? How much uncertainty is there? The economy, all I'm hearing is stagflation at the moment, which is a really difficult kind of thing to navigate.
Yeah, and I mean, on the stagflation point, I think the bank, as an inflation targeting central bank, it's inflation they're going to worry about. Growth's just going to be sort of the sideshow. I think there's going to be fog next year with Trump and the like, and the outlook for the UK economy itself. There are some issues around the tax rises that we've got and the like. But I don't think that stops them from giving us a little bit of a sense of where they're going, being a little bit more forward-looking.
Dan? Val, thanks very much indeed, both of you. Bank of England coming up a little bit later on. We've got some great coverage coming up. We're also going to be speaking to Anthony Blinken. A lot still to come on Bloomberg Television. This is Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
There is this real momentum from Wall Street.
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
As we spend some time here on the broader presidential race.
Let's focus in on European politics.
Makes you wonder how politics might play out.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space. That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
European stocks joined a global sell-off following a surprise hawkish turn by the Fed, officials raising their forecasts for next year's rate reductions. Well, the yen slides as the BOJ governor casts doubt on potential rate hike in January after the central bank actually kept its interest rates steady. Plus, a U.S. government shutdown looms again. President-elect Donald Trump opposes a stopgap budget bill, urging lawmakers to raise the debt ceiling. So all of that is playing out in the markets. First of all, European markets. This is a picture across the board. Now, we're seeing a lot of red given the Fed expectations. There's been a repricing not only on some of the European bonds, but actually equities taking a leg lower, given all of the questions about not only the U.S. economy, but of course, the support from the Fed. Cross-asset, a couple of other things that we need to watch out for. So this is a pure U.S. play. We look at U.S. 10-year yields, but also a currency, euro dollar. Again, it does seem like some of the concerns or questions about the Trump tariffs and the Trump administration are now coming into play, filtering through also to the Fed's thinking. S&P futures gaining 0.4%, and yen on the back of BOJ 15694. Now, Norges Bank has left its benchmark interest rate at 4.5% as expected. It says the rate will now most likely be cut in March 2025. So it's a central bank day. We also have BOE later. So for the conversations that matter and the insights you need, let's get started.
Newsmakers and market movers. This is The Pulse with Francine Lacroix.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, the Fed has lowered its benchmark interest rate for a third consecutive time, but cautioned over how quickly it can continue reducing borrowing costs in 2025.
I think that the slower pace of cuts for next year really reflects both the higher inflation readings we've had this year and the expectation that inflation will be higher.
Now, for more, we're joined by Bloomberg's Valerie Teitel. Valerie, so what did Powell say that was so shocking or so surprising?
Francine, it very much was their guidance for how many cuts they're penciling for next year. They dropped it down from 4 cuts previously to now only showing 2 cuts penciled in for next year. Powell also went on to say that this is a new phase of the cycle, and in central bank speak, the market took that as this is a Fed who is going on pause. And we're now even just pricing 1 cut from the Federal Reserve next year. So we're taking even a step further from their projections. There was also some very surprising things in their SEP yesterday. That members saw inflation risks now tilted to the upside. If you take a look at this in my next chart, Francine, it was very shocking just the amount of members in the FOMC who are worried about a resurgence in inflation. 15 out of the 19 members are now worried about the upside risk to inflation. With the Fed's concern squarely on inflation, this caution about Fed cuts moving forward is very much warranted.
Yeah, and the market reaction was pretty swift.
Very swift market reaction, a big fall in the equity market yesterday. One of the weakest days for the equity market post a Fed decision that we've had in 20 years. We also saw yields rising across the curve. The 2-year from the 10-year also substantial weakness in the Treasury market. We're now 12 basis points higher on the 10-year yield since that decision. The other big mover was the dollar, Francine. The dollar saw a big bout of strength, up nearly 1% after the decision. And this also played out across markets, Francine. We had the Brazilian real, the Indian rupee in EM markets, those currencies hitting the lowest that they've ever traded at versus the dollar.
And meanwhile, we also had the BOJ decision.
The Bank of Japan decision in the press conference, Ueda really convinced us that he was in no hurry to hike interest rates. And we saw the pricing for a possible hike next year evade in the market. We also saw the yen weaken quite substantially versus the dollar. It's now above that 157 mark. We have the Fed, who is in no hurry to cut rates. And then we have the Bank of Japan, who is in no hurry to hike. This means the release valve is for a weaker yen going forward.
Valerie, thanks so much. Valerie Teitel there with the very latest on central bank moves. And then, of course, we have the Bank of England later. Now, we're joined by Laura Cooper, Global Investment Strategist at Nuveen. Laura, thank you so much for joining us. You always come on when there's stuff going on in the markets. So the Fed killed the Santa rally. Okay, this is my favorite headline of the day. Did the markets overreact?
I think maybe perhaps the Fed overreacted. If we look at some of the surprises that did come through in the meeting yesterday, perhaps it was the core PCE inflation revision sharply higher, as well as what Valerie mentioned, the tilt towards members suggesting that inflation risks are to the upside. I think the surprise was really around how quickly they pivoted from focusing on the labor market back to inflation. And if we look at the November CPI print, you know, some of those sticky measures like shelter, it actually on a 3-month annualized basis is now trading at coming in at a cyclical low. So the question is, you know, could we actually see more of that disinflationary pressure next year? You know, question around policy implications of inflation, but that's key. That's really the key question heading into next year.
I mean, I guess how much of this is, you know, the last mile is always the toughest to get inflation under control, and how much of this is like an insurance against some of the, you know, Trump policies that could be inflationary?
And I think something that really stood out in the press conference yesterday when Chair Powell was asked about it was just around how many members are starting to incorporate the potential policy measures coming through next year versus actually looking at the realized data. And he did suggest that some members are incorporating, some are not yet. And I think that's really the key question for markets. Is this a central bank that continues to look in the rearview mirror, or are they actually looking at some of that uncertainty and perhaps wanting to keep that, let's say, dry powder, keeping rates in that restrictive territory to kind of make sure that they have room to ease or keep restrictive as needed next year?
Laura, when you see the Donald Trump policies, and again, there's, you know, there are policies that have not really been said with like details, but you have a restriction on labor supply. That could be a concern of the Fed because of the immigration. And then you, of course, have, you know, the promises on policies on trade and tariffs. Is that automatically inflationary?
I think certainly from the tariff perspective, it is inflationary, but to a certain degree. I mean, we've estimated it's about 2 percentage points of GDP. It's going to be a one-time price level shift. The key risk, though, is the retaliatory measures that could come through from key trading partners, in which sense that could more be the trigger for an inflationary spiral. It's not our base case at this point, but as you mentioned, the wage pressures as well. But kind of on the flip side of that, you know, what if we do see this greater deterioration in economic activity, if we do see some of those tariffs weigh on growth? In the near term, it's going to tilt activity domestically, but beyond that, I think we're going to be in a more of a challenging backdrop.
What about this uncertainty over the federal funding deal? How much of a concern is that? I mean, I guess it has implications for the balance sheet runoff.
And I think that's a key question, certainly, that we're watching for. And it's like, how do we position in this type of uncertain backdrop? I think, you know, we've been hesitant to take on duration exposure. We are seeing that 10-year yield in the U.S. about that 450 mark. That's really kind of the middle of the range that we expect to happen next year. But of course, a wide range of outcomes around that. So really, we're positioning still in the front end of the curve, playing that quite tactically. And as well, if we look at the supply pipeline coming through in fixed income in January, we want to keep some of that powder dry. We're in this thin liquidity type of environment heading into the year end. Moves are really exacerbated. So I think right now it's just kind of keeping watch for what clarity could come through at the end of January.
In the corridors of power, Laura, I keep on being told whatever happens, the U.S. will be fine. It's the rest of us that will suffer. So if you have a Fed saying this, what does it mean for other central banks?
Well, I think the key risk, the key theme that we're going to watch for next year is around monetary policy divergence. We're already seeing that play out. You know, we saw the Fed out-hawk market expectations. The Bank of Japan this morning is essentially out-dubbing market expectations. I was surprised by just the extent that they're pushing back on those upside inflationary pressures. They did allude to the fact that FX is going to be more of a meaningful impact, but yet we're almost seeing them kind of guide the market that we're not going to see a hike in January. So I think this will be a predominant theme next year. If we think about Bank of England, ECB, we could look at a number of them, but that's going to be a key thing we're watching for. That's going to drive, I think, FX and rates volatility.
So ECB, and we'll come back to this, but do you think ECB can also be more dovish than expected?
I think if we look at what the market implied path is now, so looking at that terminal by the end of next year around 175, it's actually fairly kind of priced, I think, at this juncture. We do have a lot of those downside growth risks baked in. You know, Christine Lagarde said, you know, the direction of travel is clear, you know, the magnitude is clear. I think this is an ECB that, yes, they're data dependent, meeting by meeting basis, but I think they're guiding us to suggest that we are going to have kind of that steady pace of cuts next year.
Laura, thank you so much. Laura Cooper there from Nuveen stays with us. We'll talk a lot more about the ECB, and we'll also, of course, touch on Bank of England. Now, some corporate news we're watching. Micron tumbling pre-market after its revenue forecast missed projections by about $1 billion. Now, the largest U.S. maker of computer memory chips was hurt by sluggish demand for smartphones and personal computers. Micron pre-market down 14.5%. Now, coming up, a U.S. government shutdown looms again as President-elect Donald Trump opposes a stopgap budget bill. So we'll have plenty more on that story next. And this is Bloomberg. From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at the Forbidden City in Beijing, and this is Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
You're watching The Close. Welcome to Balance of Power.
This is Bloomberg.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling.
Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
Now, President-elect Donald Trump says he opposes a proposed government funding bill threatening a stopgap measure that would keep the government open until mid-March. Bloomberg's Joshua Galou joins us now for more on this. So, Joshua, thank you for joining us. What is Trump's preferred scenario, and is that even realistic?
Well, it's getting more realistic by the day because he's put Speaker Mike Johnson in a very difficult position. What he said yesterday, his ideal scenario is that the current spending bill that's now basically been rejected include already a provision to suspend the debt limit. That is basically setting up. He's showing what a fight that he's going to have on spending going forward. The question is whether Johnson can still pass a continuing resolution, which would keep the government being able to spend for the next 3 months by Friday, at which point the government would shut down if he doesn't on Saturday. And to do that, I think he'll need to trim off some of the things that he had already loaded into this spending bill to compromise with Democrats. That's tens of billions of dollars in hurricane relief, farm aid, and other things that Republicans don't want, certainly on the farthest right portion of the Republican Party.
So where does this leave negotiations over the spending bill?
As of Wednesday night, there was really no new proposal. So they're going to have to start fresh again now and hopefully get to something by Friday to prevent a shutdown. But, you know, Trump has really laid out a very strong position here. He wants the debt limit to be suspended on President Biden's watch, so he doesn't have to have that fight when he comes into office in January. The most likely scenario seems that Speaker Johnson will trim this down to a very slimmed down version of what he currently has, and have to rely on the whole set of Republicans, some solidarity there to get this thing through. It's really not a great look for the Republicans to shut down the government right now.
Thank you so much for joining us, Joshua Galou, there with the very latest, of course, on what's happening in D.C. Now, still with us, Laura Cooper, Global Investment Strategist at Nuveen. Laura, I mean, I guess the concern, and I don't really know how to read this, is that if you're a global strategist, you say, right, we're going to have a lot of volatility. We thought it was a done deal. Anything but. So does it change your risk perception, or does it just impact? We don't really know how much he'll focus domestically on what's happening in the U.S. and how he influences foreign policy.
And I think it's a key question facing policymakers, and just the fact that how much could this kind of tariff impact actually impact, the growth profile? Markets are really kind of built on this U.S. exceptionalism, which we do still is going to think is going to persist next year. But then the key question is, okay, how do we kind of other countries react to this? So we've revised down our European growth forecast on the back of this policy uncertainty from the U.S. And we saw Bank of Japan Governor Ueda overnight saying, they're starting to weave in this uncertainty around U.S. policy in the new administration. Perhaps that's a reason to be cautious. They may not have clarity by the end of January. So this is going to have a ripple effect, I think, across global markets.
Laura, I mean, when you look at some of the, concerning, I guess, trends in Europe, it's a lot of countries are trying to find a government or even are going to elections. So France, we don't exactly know what happens with this very divided parliament. Germany, we have early elections in February. How do you play that?
I think at this point, you're right. It's the political uncertainty is really the dominant theme entering into 2025 for Europe. I mean, if we think about the German election, perhaps markets are getting a little bit overly exuberant that we could see fiscal flexibility come through. Yes, we could see a new coalition come through that maybe is going to be a little bit more kind to fiscal tendency, but it's going to be a period of prolonged negotiations, and even then, they're going to have to be amenable to fiscal hawks. So we could see some modest reform to that debt brake reform, but even any type of fiscal stimulus is likely to be, let's say at most, 0.5 to 1% of GDP, so perhaps not enough to really move the needle. So in our mind, from a positioning perspective, we still like German boons. I mean, they're probably fairly priced at this point, but it's the periphery exposure for that carry opportunity. That's where the growth has really been driven, and then maintaining that structural underweight in terms of French government bonds. Yeah. Perhaps if we see more of that uncertainty play out, we could start to look at buying that dip, but not at this juncture.
What about the Bank of England? I mean, there was a huge move, actually, when it came to gilts this week.
I think the price action, we can't read too much into that. I think there was, thin liquidity. We're also seeing a lot of those positions being stopped out, which does tend to be disorderly. I think when we think about the Bank of England today, we'll be watching for two key things. Yes, it's just a statement-only type of decision, but is there any assessment about the recent upside wage pressures? I think that's something going to be interesting to watch for. And as well, this ongoing uncertainty about the budget effects on UK businesses. So we think they're going to maintain this gradual approach, but really it's going to be the key. Are they going to continue to look at that realized data, or are they going to shift focus to maybe a trajectory for inflation that's lower and growth as well that's under pressure?
Laura, thank you so much, as always, for coming on, especially on such a busy day. It's like central bank week with a lot of market surprises. Naveen's Laura Cooper. Now, coming up, a warning about Syria's new government. In an exclusive interview, we hear from Israel's deputy foreign minister about her administration's doubts. That's next, and this is Bloomberg.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg's covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg. From the world of politics to the world of business, Joe Matthew and Keely Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Well, Israel's deputy foreign minister has described Syria's new leaders as wolves in sheep's clothing who are trying to persuade the world they are not radical Islamists. Well, Sharon Haskell told us exclusively that her government will not be fooled by the rebels' public comments.
We're not fooled by many of the conversations and the interviews that those, rebel groups, who are in fact terrorist groups. Let me remind you, al-Jolani, he was part of ISIS. Al-Jolani was al-Qaeda. And right now, the way that they speak, we are very aware of what they're saying, but the fact is that we are going to look on their actions, and that's going to dictate how we react to that. These are wolves in clothes of sheep, and we are not fooled by nice talks. I think that one of our worst mistakes leading up to the 7th of October is that conversation about peace, about coexistence, about that conversation that Hamas has said that they will not intend, and the Western media who have described Hamas as a legitimate government of the Palestinians, and Israel has paid a horrifying price on the 7th of October. We will not do the same mistake again. We will follow up close on the actions of those different militias groups and the new government of Syria. And the one thing that is in our mind is to make sure that we can protect and defend our borders and our communities.
Mm-hmm. Can you give us an idea of how deep Israeli ground forces are in southern Syria today?
We just a few days ago, and it was already widely reported, Israel has entered the buffer zone. The buffer zone is an area that was meant to stay clear of any armed groups, including armed militias, and unfortunately, those rebel groups have violated the disengagement agreement signed since 1974. Those groups were trying to attack also United Nations positions that were located there. And following up the situation, we've decided to enter the buffer zone to make sure that it stays protected and that those militias groups, those terrorist organizations are not set close to the Israeli border. There was another part up in the north of the Golan Heights where we actually took a part from a topographical from a topography point of view, a higher point so that they cannot surprise us. And in that respect, these actions are temporary and obviously limited. And the main goal was to defend our country and to defend our people and the communities that some of them live on that border.
Well, that's Israel's Deputy Foreign Minister Sharon Haskell. Now, later today, we'll be speaking with the U.S. Secretary of State, Antony Blinken, about the Middle East, as well as Ukraine, and the foreign policy transition under a second Trump administration. Don't miss that interview, 1:15 p.m. London time. Now, the U.S. Supreme Court says it will hear TikTok's challenge to a law that would ban the app in America next month if it isn't sold by its Chinese parent company, ByteDance. The arguments are scheduled for January 10th, a little more than a week before the ban takes effect. Meanwhile, the EU has started an investigation relating to concerns that TikTok did not do enough to stop fake accounts and foreign powers from interfering with last month's Romanian presidential election. Coming up, the UAE's biggest oil producer takes control of German chemicals giant Covestro. Our interview with Khalid Salmin, ADNOC's downstream industries head. That's next, and this is Bloomberg.
missed it on Bloomberg Technology.
We're excited to really change the expectations for space companies, where you have this always-on, reliable, and frankly dynamic satellite connectivity that you would expect of your power grid or of your cell phones. And so we think that this is a huge opportunity space, and our first contribution to it is through shared infrastructure.
You can see this whole ecosystem developing, and you have an exponential growth right now because easier access to space means more demand for space, and that's the definition of an exponential growth function. So if you think about someone like Varda, who is only possible now because access to space is cheaper and easier, we're demanding more access to space.
I think that's what's so exciting from a business perspective, the fact that if you can do it, you're one of the few numbers of organizations in the history who've actually pulled it off. And so it creates a very defensible position, because again, space is very, very hard.
Don't miss Bloomberg Technology live every weekday.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Rio de Janeiro, Brazil, and this is Bloomberg.
Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. European stocks join a global sell-off following the surprise hawkish turn by the Fed. Well, officials rein in their forecast for next year's rate reductions. The yen slides as the BOJ governor casts doubt on a potential rate hike in January after the central bank kept its interest rates steady. Plus, a U.S. government shutdown looms again. President-elect Donald Trump opposes a stopgap budget bill, urging lawmakers to raise the debt ceiling. Now, in other news, the United Arab Emirates' biggest oil producer has secured nearly full ownership of German chemical maker Covestro. That's after the end of an offer period open to all shareholders. Now, ADNOC offered nearly $13 billion for Covestro in what's set to be the largest Middle Eastern acquisition of a European firm. Now, for more, I'm joined by Khaled Salmin, ADNOC's downstream industries head. Mr. Salmin, thank you so much for joining us. Now, first of all, for international viewers, I mean, you basically have XRG, which you want to double. It's an investment vehicle to get natural gas, chemicals, and low-carbon energy with a mandate to double, I think, your enterprise value over the next decade from $80 billion now. So first of all, congratulations. This is the first big deal. What's the path forward?
Well, clearly, this deal was a milestone deal for us. We are very happy with Covestro. It's a solid company. This company has huge innovation, invented the chemistry back in the 1930s, has 13 R&D centers around the world, over 8,500 patents, and it does operations across the world. So it's a truly global company. I think what is important for us now is to know that while we got to this really good milestone, there's still a significant amount of regulatory approvals that we need to go through, which we are very focused on, and we are engaging with all the regulators to go through that process. As we have just launched and we announced the board last week, XRG is going to go into operationalization, and we are in that setup stage, and we are going to really focus on the international gas, the global chemicals, and low-carbon fuels, and we see a huge number of opportunities that we can look at. So we are very excited.
I mean, it's a very exciting space to be in. So this basically, with the acquisition of Covestro, it'll make you one of the biggest chemical players in the world. Do you want to replicate that with other parts of the business in XRG? Are you going after big companies, or could it be smaller acquisitions?
I think that's the strategy is not the same. So low carbon fuels is a little bit more nascent market. So we're talking about blue ammonia, biofuels. Those regulations, incentives, penalties around it is not as mature as, for example, international gas and LNG. Yeah. So it really depends, and that strategy will have to be between greenfield, brownfield, as well as an M&A. So it's a combination. We are in that process where we are trying to kind of put the whole portfolio together and see what is the right mix as we go forward.
I mean, you also have a JV, I think, with BP, right? Are there more assets that will go into that?
So at this stage, given where we are, we have not really declared what are the exact assets that will be, and that's for obvious reasons. We are definitely looking at international gas assets that are going to be a part of that. So similarly with the global chemicals, for Covestro, again, this is clear. That's the bidding entity. XRG's biggest deal is on Covestro, and we are yet to go through that regulatory approval.
I mean, in terms of chemical makers, you have Borouge and Borealis. Does that also fold under XRG, or is that still to be decided?
It is to be decided, obviously. Borouge is a publicly traded company, and if we are to go through that process, we will have to go in a systematic manner. I think it does make sense to think about those portfolios as a value chain where you can optimize between them. But in our global chemicals, we've always been focused on polyethylene, polypropylene, polycarbonate, polyurethanes, acetyls. These are the value chains that we've been very interested in, and we will continue to be interested in. And clearly, as a portfolio, there is a lot of synergies that can happen. But for us, Covestro is a standalone platform, a growth platform. It's a long-term partnership with a long-term view, and we are very happy with what we have achieved so far.
So what exactly is next over the next 12 months? I guess it's regulatory approval, integration, and your strategy seems very focused, of course, on chemicals. Do you need extra refineries to make sure that the chemicals are turned into something else?
So clearly, with Covestro, it's a standalone business, so there will be no integration of that. We see this as a standalone company, and we have a growth strategy around it once we are done with the regulatory approvals, clearly. With relations to refineries, we are not really focused on chemicals that depend a lot on naphtha or crude and liquids. We're focused on ones that are mostly based on natural gas. And as such, refineries would have to look at it case by case, but it's not a part of the core strategy. In the refineries, we can see that come potentially in the biofuels.
Right.
So in our strategy, the biofuels, the biodiesel, SAF, are interesting fuels of the future, and we will continue to look at those and see how we develop them.
So PetroChina, of course, China's largest oil company, said last month that they see peak oil demand in China next year. Is that also your base?
I would probably see that from an EV penetration.
Okay.
So while they are talking about it from a general, I would say that's probably peak transportation fuels rather than peak energy. I do expect them to maybe grow in their energy demand, but not in gasoline demand. So as such, these are important differentiations. I think what is clear is that the energy needed for delivering growth in the long term will always be there.
Yeah.
Low carbon energy will have an advantage. And I think, we need to keep track of the mega trends, the AI demands, and taking that power all the way to deliver that. So, yeah, there is redistribution and evolution and transformation happening in the energy market.
So does India, can India actually absorb some of that demand if it's coming down from China?
I think globally, we see the fundamentals around the oil markets are strong. Obviously the Fed's got the interest rate. That's a bit of a bearish news in the forecast, but personally, I think the fundamentals are still solid, and we will continue to see that growth. We are far away, I believe, in my personal view, from that peak oil scenario or peak energy. Now, a lot of the agencies that follow that have revised their forecast over the last 2-3 years, and you can see that there is more energy demand. Now, the question is, what is the most sustainable, low carbon intensity fuels to fuel that growth?
But do you worry about the Trump administration flooding, actually, the world with extra oil, American oil?
I'm not worried about the oil markets. The oil markets are very resilient. They are well-balanced, and the arbitrages closes very quickly. I think supply-demand fundamentals will always be there. And at the end of the day, as long as you are a producer that is first quartile with a low carbon footprint, you will always be in these markets, and we are a very reliable supplier in that sense. So as potential developments in shale comes in, they will have their own challenges, but at the same time, they might have a slice of the market.
What will be your main challenge in the next 12 months?
I think right now we're very excited about what we have achieved. We are very excited about going through the regulatory approval with Covestro, and we are hoping that over the next few months that we are able to get that over that main hurdle and work with the management to develop the growth strategy.
Khaled, thank you so much for joining us. That was, of course, Khaled Salmin, ADNOC's Downstream Industries head. Now, coming up, EU leaders gather for the final time of 2024 in Brussels. These are live pictures. We see a lot of them, of course, coming in. The Chancellor of Germany, Olaf Scholz, taking a bit of a doorstep with a lot of reporters on the ground. We'll also be on the ground at the summit next, and this is Bloomberg.
Is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space. That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers jobs day like Bloomberg.
DOJ or other authorities
could face bigger challenges next.
It was going to keep Great World Cup. This is a 3.
As the economic picture.
Covering the intersections of Hollywood, Silicon Valley, and beyond.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg. Alice Weidel is the first ever chancellor candidate from the far-right Alternative for German party. Now, the party is currently second in the polls ahead of the country's elections in February. In an exclusive interview with Bloomberg's Oliver Crook, she slammed the EU for undermining the country's auto industry and called for a German exit from the bloc.
We don't see that the European Union in its current state is an institution that is working well, right? So what we need to have is free trade among the European countries, but we don't need all the bureaucracy. So example, the European Commission, which is actually not voted, right? So you have a executive power like the Commission with also legislative power. That is not elected. So this is a huge democratic deficit. So this commission decided just to forbid diesel and benzene, like all the traditional fossil motor, right? So what happens is that they actually ripped off the German automotive sector.
Many people are critical of the EU on many of the points that you make here, but very few are making the case for withdrawal from the EU, and specifically on the euro. How do you envision that happening? Was it a return in Germany to the Deutschmark? Is it then? Explain to us the mechanics of how you imagine that working if you had your way.
Well, this is the entire discussion around the Dexit, right? Yeah. So we think that the European treaties need to be reformed so that every country within the European Union has a right, first of all, to have a veto against the Commission. For instance, that the German government could say, okay, we don't agree, we say no. So the veto power in the European treaties. And if a country wants to leave the European Union, why not falling automatically into a free trade zone? I highly recommend just a free trade zone, because all the bureaucrats, thousands of them, like eating up taxpayers' money, they just disturb real competition among the European countries. We don't need all of these bureaucrats that have actually who have no clue what they're doing and destroying our foundation in the European Union.
Alice Weidel there, the far-right alternative for Germany, of course, candidate for Chancellor. Now, Oliver joins us from Brussels, where EU leaders are gathering for their final meeting of the year. Ollie, connect, of course, the domestic situation in Germany to what's happening in Europe.
Yeah, I think it's a fundamental question, Francine, because when we think about what the issues before the leaders here are, I think there's one topic that isn't officially on the agenda but is on everyone's mind, is the fact that basically you have major dysfunction in the two sort of twin engines of European politics at the very core of the EU, in France and in Germany. And what's interesting on the side of the sort of French side versus the German side, as you know, Francine, Marine Le Pen herself really abandoned this idea of leaving the EU and leaving the euro. That is not the case for Alice Weidel, who is basically saying that not only does Germany need to leave the EU, it needs to leave the Eurozone. So the point is that she will probably not have any actual power in this election, though she has been very powerful in evolving the debate in Germany, certainly on the topic of immigration. And with 1/5 of the vote, with 20% of the vote, it is impossible for the sort of German political establishment to ignore the AfD at this point. So this is something that is going to be present in the minds of leaders here when they're thinking about the dysfunction. Of course, the other thing that is looming, we just saw Zelensky walk in. How much more support can they bring forward to Ukraine with Donald Trump coming into the Oval Office very soon over in January? I think that there is a recognition, at least from Zelensky, from what he just said here, that basically there is no path forward without full U.S. support. And I think the Europeans, though they say that they need to be standing by Ukraine till the very end, they are not really protagonists in this war. They are paying for some of the gas, but they are not driving the car. These are going to be the issues before the leaders here. And also, how do you sort of Trump-proof some of the initiatives here in Europe, because this is the last meeting before that inauguration over in January?
Ollie, thanks so much. Oliver Crook there with the very latest, of course, on the summit. Now, Russian President Vladimir Putin is addressing the nation in an annual end-of-the-year speech. He's also taking part in a phone-in with Russians. It comes just days after a Russian general was assassinated in Moscow, which Ukraine has claimed for. Now, to discuss all of this, we're joined by Bloomberg's Stephanie Baker, who's also the author of Punishing Putin Inside the Global Economic War to Bring Down Russia. Stephanie, thanks so much for joining us. I mean, there are live pictures, which we'll get to in a second, where you see Vladimir Putin surrounded by, I think, about 300-400 people. This lasts like 3-4 hours. He's had a bad week. I mean, let's be clear, he's had a bad 2 weeks because of the assassination of the general in Moscow, but also because of Syria.
Absolutely. And you see, this is a highly scripted event, and he uses it as a sort of demonstration of his control over the political scene. It's got started off this morning dominated by questions around the economy. It just came out this morning that inflation is now at 9.5%. Now, that's partly due to sanctions, as well as his record spending on the war. But, inflation is beginning to bite, and it's not responding to the Russian central bank's efforts to cool it. Interest rates are now at 21%. And are expected to move up further. And there's a lot of political tension over this, with various figures, business leaders, complaining about the high interest rates and warning of potential bankruptcies. So we'll see how many questions he gets on the economy during the course of this event.
I mean, I find this event quite fascinating because it's on the course, over like 3-4 hours. Are they real questions, or are they, hard enough that they make him look good, but they're still very managed?
I think exactly the latter. They're edited heavily. They're meant to allow him to show off the issues that he thinks are important, as well as to try to stamp out criticism. And I think one of the things he's been trying to do is separate the rising inflation from the war, to try to demonstrate that these are two unconnected events and that he's got the situation under control. He did say today that inflation is a worrying signal, but remember there were additional sanctions a couple of weeks ago on Russian banks, in particular Gazprom Bank, which have been used for energy payments globally, and that caused the ruble to fall to 113, 114 to the dollar, and he had to actually come out and say there's no reason to panic, and that's never a good sign.
That's never a good sign. And also, our most read story when it comes to Russia is actually, the central banker, Elvira Nabiullina, who for such a long time was considered one of the best, is now also under attack from officials who say that she's destroying the economy with his higher interest rates. So when we look at the Trump administration incoming, how does this change Vladimir Putin's thinking on what he wants to do with Ukraine? Does it change?
Well, the only person the only figure that can be attacked is Nabiullina. He cannot be directly attacked. So in a weird way, the attacks on her are an indirect attack on the situation broadly. He has said, he's ready for negotiations, but in reality, what he wants is going to be very difficult to come to an agreement with Ukraine. He wants Ukraine to be neutral, not to join NATO, to have caps on its military, and it's hard to see how Ukraine will be able to agree to that. And I do think I'll be looking out to see if he gets questions on the murder of this general, Kirillov, which was a remarkable attack. And I think there will be fallout from this. I think we're going to have to see what kind of response Russia has to this, whether it's a stepped-up response in Ukraine or perhaps on a NATO country.
So I'm fascinated by this because I've heard, look, this is just a tactical it was a thing to do tactically to, being closer to not losing in the war on Ukraine's part. But I've also been told this is a great way to show off to Donald Trump, to say, look at what us Ukrainians can do so that he supports Ukraine more. What do you think that was?
Well, absolutely. And, this shows the sophistication of the Ukrainian intelligence operatives that they were able to pull this off. I think it is meant to show that they do have power. They are able to disrupt and bring the war home to Russia, which I think is really important to try to undermine support within Russia for the war. But Ukraine is in a really difficult position with Trump coming in and vowing to end the war in a day, with waning support in the U.S. for continued military and financial aid for Ukraine.
Stephanie, thank you so much. As always, Bloomberg's Stephanie Baker, who's also the author of Punishing Putin. It's a great book. It came out about 6 months ago, Inside the Global Economic War to Bring Down Russia. Now, coming up, annual bonuses at Barclays could rise by up to 20% as expectations rise for awards on Wall Street. So we'll bring you that Bloomberg scoop next, and this is Bloomberg.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything. Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg's covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg. Get your fixed income fix. Half an hour dedicated to fixed income. Watch Bloomberg Real Yield. Context changes everything.
Welcome back, everyone. A huge repricing when it comes to money markets. Traders now only see a 50% chance of BOE rate cut in February. Again, there was a huge swing in the last couple of days, and I think that's probably exacerbated by the fact that Powell's also signaling a hawkish Fed with the focus has returned to firmly coming down inflation. Now, Bloomberg understands that Barclays is set to increase annual bonuses by as much as 20% after an improved year for traders and investment bankers. According to its annual report, bonuses at the bank fell 43% across the board last year. Now, for more, let's bring in Bloomberg Opinion's Paul Davies. Paul, thank you so much for joining us. I have a million questions on banking, but this has, I guess surprisingly been a good year for Barclays. The bonuses are high.
Yeah, no, it's been, I think across the board, it's been a much better year than lots of people would have expected. Right. Earlier in the year, M&A has been kind of slower to pick up than some bankers would have wanted, but that's kind of improved through the year. But in investment banking, debt capital markets have been on fire like all year long and have really been leading all of the kind of the fee income there. And trading has been pretty good. We've had a lot of political events this year, obviously the US election being the biggest among them. And, I think there was worries that everything was going to get very, very quiet around that. But actually, things were quite busy in the lead up. And then the kinds of volatility that we've had since have been great for traders, I think.
So what do you expect in 2025? I guess we look at IPOs, we look at possible deals, but just in general, deregulation from the U.S. will probably occupy a lot of your writing time.
Yeah, maybe. I think there's, it's still very uncertain. There's obviously this kind of this strong sense that Trump is going to be deregulatory by nature and that he's going to want to kind of free things up. There's going to be tax cuts, fewer restrictions, we'll all be off to the races. But, and especially in M&A, there's this strong, populist strain within his team, within his party. Among some of the picks for some of the important jobs, J.D. Vance, the vice president-elect, has always been a big sort of, or not always, but, in recent years, a strong campaigner against, corporate power. I think, a lot of scrutiny will remain in things like pharma, in big banking, in tech especially. I think there's going to be a good bit of M&A, almost certainly, but whether the really big deals and in some of those, really focus areas will pick up is another question.
And Paul, thanks so much. And that's my must-read, actually, of the week. Paul did this great opinion piece saying, look, mega deals will probably not lead this M&A rebound under Trump. Up next, Bloomberg Brief, Manus Prani in New York. Of course, they'll be full in on the Fed reaction, what the markets are doing, and of course, they look ahead to the BOE. This is Bloomberg.
you are also an owner, I should have pointed out, of 3 major sports teams.
That's right.
And you're the first woman, as I understand it, the first woman to own 3 major, have stake in 3 major sports teams. Is that right?
Yes, and we'll say African American.
You were approached by the owner then of the, I guess, the Washington Wizards and the Washington Caps about maybe buying the Washington Mystics, which is the women's basketball team. And what did you say?
Well, first of all, it was Abe Pollin. He did come to me and Susan O'Malley, and they said, Abe Pollin says, look, I want you to be the face of the Washington Mystics. And I said, what do you mean be the face of? He says, I want you to buy this team. His health was failing. And I have to tell you, and a lot of women can understand this, we never get these opportunities. So that was the first thing that struck me, and I was flattered. I was really flattered. I said, well, Abe, what are the financials on this? And he handed them to me. He says, well, they're not making money. But I was still intrigued about team ownership.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
There is this real momentum from Wall Street.
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
Good morning from our global headquarters in New York. I'm Manus Cranny. You're welcome to Bloomberg Brief. Let's set that agenda. Global risk reassessed as U.S. stocks post the worst Fed day since 2001. Markets are jolted with a post-hawkish Fed and a cautious BOJ setting the tone for 2025. Not so fast. President-elect Trump and Elon Musk opposed the proposed funding bill, increasing the likelihood of a government shutdown. Micron plunges after nearly $1 billion miss on the revenue forecast due to sluggish demand for smartphones and PCs. Good morning. As I say in the headlines, it was the worst day for U.S. equities on a Fed day since 2001. Now, we've settled our nerves a little bit, but there was a wholesale ransacking of risk yesterday. SPOOs were down by 3%, the NASDAQ down 3.6%, and the Russell was crushed by over 5%. The killer blow, Julian Emanuel said, came on the question, can you rule out a rate hike in 2025? You don't rule anything completely out or in. And what started as a market pullback turned into a violent volatility event. To the bond market, this is where the depth charge was really set off. 10's up by 11 basis points, 2's up by 11 basis points, as the Fed skewered the dots from 4 cuts to 2. I would say the bears were reawakened yesterday, but the vigilantes are still in hiding. It was a close call for this cut. That is the most interesting line of it all. It was a close call, and there was dissent. Bonds firm at 452. Stocks we're keeping an eye on for you this Thursday morning. Micron missed its revenue forecast by almost $1 billion. That's as a result of lackluster demand from the makers of phones and PCs. We'll discuss that later this hour. MicroStrategy is rising as the CEO, Michael Saylor, plans to focus on fixed income securities to raise the capital that he wants for buying Bitcoin. And Tesla rebounds after being down as much as 10%, its biggest drop since October the 11th. It was a brutal day for Tesla. And in just a few moments, we'll begin the conversation with RBC's Mark Dowden. Adam Posen of the Peterson Institute for International Economics join me to discuss post-Fed and post-BOJ, pre-BOE analysis. A lot to play for. President-elect Trump the tariff plan. It continues to have traders worried about inflation. Chair Powell discussed just how much of an effect it might actually have.
There are just many, many factors that go into how much tariffs will even go into consumer inflation. How persistent will that be? And so we just don't know really very much at all about the actual policies. So it's very premature to try to make any kind of conclusion.
Warning signs from Chair Powell. Well, Mark Dowding is the CIO, the Senior Portfolio Manager over at RBC, weighing in on the decision. Wise men follow new lights in the night sky. Welcome to Christmas in 2024. Mark, good morning. I know that's the title of your piece. I would say that the Bears had a field day yesterday. There's a number of elements that were juxtaposed in this speech by Powell yesterday, but I'm drawn to your line, the new light. The new light that is the guiding path, I presume, is the orchestra playing at Mar-a-Lago, which is the tune of tariffs.
Well, I guess you'd probably make that point, but I would say that in giving this a bit of a Christmas theme, I wouldn't be declaring Trump the savior or anything of that particular nature. But certainly it does seem like something momentous is going on, something different is going on. We're seeing a new narrative here. And I think we're going into 2025 with a lot of uncertainty ahead of us, aren't we? It's uncertainty in the economy, uncertainty in politics and in geopolitics. It really does feel like interesting times that we're living through right now.
So momentous in terms of the trajectory for rates. There's a building coalition of the pause, but I just wonder to what extent do we now, how low is the bar to a hike in 2025, given everything that you listened to yesterday in that Powell conference?
Yeah, so when it comes to looking at rates next year, I mean, for the time being, we're pretty confident that rates are going to be on hold in the first half of the year. Any easing is obviously going to be predicated on much weaker data. But when it comes to the question about what we would need to see in order for the Fed to be hiking next year, here I'd really be focused on inflation. I reckon if you end up with core PCE, which is currently at 2.7, up at 3.5% and looking like it's on a rising trajectory, at that point the Fed won't have any option. It will be obliged to raise rates at that particular juncture. We've seen how the American society rejected or was very upset about higher inflation in this year's election. The Fed took its eye off the ball in terms of inflation in 2021. It can't afford to do so again. So if you do see that sort of inflation pressure build to the upside, then I think that's really representing the Fed's pain threshold in the course of the months ahead.
And it's interesting, they raised their PCE projection to 2.5%, and that is without knowing anything of the detail of tariffs. I used the word ransacking of risk, and there was. I mean, it was virulent in the S&P, the Russell down by 5% at one junction. The bond market, I would say, was irked, but the vigilantes are still in hiding. Are we done with this rout?
Well, I think in the near term, let's wait and see. I wouldn't like to sort of really give an answer to today's price action, but I would say that risk premia had been very much compressed in credit markets, in equity markets over the course of the recent weeks in the period post the election. And in many respects, we've ended up in a situation in the last month or two where everyone has wanted to cheer on stronger growth and the positives about the Trump agenda. But obviously the flip side to that is if we're in a world where rates are staying high for longer, then this is clearly more problematic for long duration assets. And you have to remember all the while that equities are long duration assets. These cash flows, particularly on high multiple stocks, they represent long duration assets. And so if we're seeing a move up in longer dated yields, as we're seeing at the long end of the Treasury market, then that does have an influence for the rest of the risk complex.
Okay, look, one thing which the market was caught offside about was Japan. Ueda prevaricating, he wants to wait until the spring before he has the evidence on wages to go with a hike. Are we entering some kind of a policy era with Ueda prevaricating so much?
Look, I think there is a building risk of this, actually. I think that it's been interesting listening to the Bank of Japan over recent months and really articulating the fact that they're expecting to normalise policy if data evolves as they have been looking for. And in fact, the data is moving in that direction. We're seeing stronger inflation. We're seeing evidence of rising wages. In fact, tonight we'll get some more inflation data in Japan, which should show another jump. And so from that point of view, with data doing its thing. The question is, why is the BOJ not sort of delivering on its commitment to actually normalise policy at a time when real interest rates are super accommodative? And I think here what we might be seeing is actually some political interference coming into play, given the fact that we've got a very sort of weak government in terms of the LDP in minority, wanting to get some support maybe from the DP in order to shore up a bit of a working majority. So there may be political factors, but I was very surprised that UAID's press conference didn't seem to firm up expectations for a January move. That's what we would have thought, and so I think that the January meeting now is going to be pivotal for the BOJ. It's about 50% priced. A lot will be riding on that January meeting.
And that takes us through then to these swoons in yen, these bids in dollar. For you, I presume, is an opportunity to sort of look at the crosses. I know that you want to be long yen. Do I look through today's verbiage from UAID and say, look, I do want to be long yen. I want to be long it on the crosses?
Yeah, look, the yen is fundamentally a very cheap currency, right? And if you want to do your Christmas shopping, if you're doing your Christmas shopping this year, you could do it in Japan and save about 30% off your price of everything. It was really quite striking how price levels are really kind of somewhat out of whack in many regards. And so from that perspective, you want to be buying the yen. You can see interest rate differentials narrowing and converging over the course of the months ahead. And so in many respects, you think that 2025 should be the year of the yen, but it does depend on the BOJ delivering on rates and, as you mentioned, not delivering too much of a dovish tilt to policy as they did at points last year. So we do think that the yen can do well, and we particularly like the idea of owning the yen relative to the euro. We still think for the time being that we're in a strong dollar environment. In the short term, we think this sort of Trump agenda favours the dollar, but structurally owning the yen against the euro in our eyes is really quite a compelling trade for 2025.
Can't let you go. Danny's not here, but I know that she'd ask you this about Chelsea winning 2 trophies. Really? But your political scouts, very quickly, tell me number 8 on your big calls for 2025, the political scouts that will go, and some of them that are first buddies.
So I reckon Trudeau is obviously gone in the course of the next couple of months in Canada. Poilievre looks like he's going to win the election when that gets called. That seems to be a slam dunk with the Liberals or the Conservatives 20 points ahead in the polls. I also think that Elon Musk isn't going to last in the administration under Trump either. I think the king of Doge is going to get bored, he's going to get frustrated. I can see how the love affair could easily cool. So I reckon he's gone late summer to focus on SpaceX or something a bit more interesting. And I would also say that at the moment, the way things are moving in the UK, I reckon Rachel Reeves sadly will be gone this time next year. I think the Labour government is in a difficult situation. We're seeing UK yields climbing higher and higher. We're in a situation where the Bank of England today, I can't see them cutting rates at all. The bank would like to cut rates, but the honest truth is that inflation is too high, and as yields rise, this is feeding back into the fiscal problems that we're seeing in the UK. And from that point of view, we're quite worried that actually if you do sort of bust through the previous highs in yields that we've recorded in gilts in the trust tantrum, you're going to be in a situation where Reeves is obliged to deliver tax rises.
That's some pretty big scouts to go, but I'll remind Danny you're still there for Chelsea with two titles for next year, 2 trophies for next year. Mark, thank you so much for being with me. That's RBC's Mark Diding on reaction to the Fed and BOJ. There are other stories, and they're trending on your Bloomberg terminal. They look like this. Volkswagen Labour leaders are moving closer to a deal to restructure without shuttering the factories in Germany. The agreement would involve workers giving up bonus payments in exchange for job security until 2030 and the implementation of cost-cutting measures. LVMH has acquired a historic villa in Cannes in France for around $52.7 million to showcase the brands during the city's star-studded festivals. It will use the 12-bedroom property to host exclusive shows and events for its companies, which include Louis Vuitton. The company plans to rent out the villa during the summer months when the tourists flock to the French Riviera. Maybe it'll be on Posh Go. You never know. Barclays is set to increase its annual bonuses by as much as 20%. Its investment bank, after an improved year, for traders and advisory teams. That's according to Bloomberg reporting. Staff in the trading unit are expected to see a 5 to 10% rise in their annual awards, while bankers in debt and equity capital markets could see their bonuses jump by 10 to 20%. Bifurcation and bonuses. Coming up on the show, Trump and Vance don't want a stopgap funding bill. They want a debate. More on the story next on Bloomberg.
Okay, today I'm going to talk about how to succeed with a startup. Obviously, more than can be said here in 20 minutes, but I will do the best I can. The most important thing, the number one lesson we try to teach startups is that the degree to which you're successful approximates the degree to which you build a product that is so good, people spontaneously tell their friends about it. Startups always ask us for the secret to success. They always want to believe it's something other than this, because this is really hard to do. But this is it. If you can build a product that is so good, people spontaneously tell their friends about it, you have done 80% of the work that you need to be a really successful startup. If you think about the most successful companies you know, Google, Facebook, whatever, you probably found out about them because a friend of yours said, you got to try this, it's great. So this is the bar. Something that people love so much they tell their friends about it. One important indicator for a product like that is a product that's simple to explain and easy to understand. If you can't explain in a few words what you do, and if at least some people don't say, oh, that's pretty interesting, that's usually a mistake. It's usually a sign of unclear thinking or a need that is not big enough.
I want a bank that shows me what I spend instantly.
We're Monzo. Give us a go. See?
Well, I want a bank that can help me budget for the things I need. Like a new leather jacket for Bingo.
We can do that.
Bingo's my cockapoo.
Hi, Bingo.
It's a real faff to sign up.
It takes less than 10 minutes.
Race you.
You're on. Time's up. How'd you get on?
It's a draw.
Is it? We hear you, Bingo. You make Monzo Monzo.
After Fed dials back rate cut ambitions.
Mm-hmm.
So what's the connection between the Fed and the pound's sudden dip? And more importantly, what does it mean for you?
Yeah, it's a fascinating example of how interconnected the global financial system really is.
Right.
What seems like a purely American monetary policy decision can ripple out and impact currencies across the globe.
Okay, so let's start with what the Fed actually did. They cut interest rates by 25 basis points. But here's the catch.
Okay.
The markets were expecting a more aggressive move.
Right, and that's why this seemingly small cut sent such a shockwave. Remember back in September when the Fed projected 4 rate cuts for 2025?
Yeah.
Well, now they're only anticipating 2, totaling a 50 basis point reduction.
Oh, wow.
This less accommodative stance, combined with only 1 dissenting vote to keep rates unchanged, really threw people off.
So it's not just the rate cut itself, but the signal it sends about the Fed's thinking, right?
Exactly. The markets are reading this as a sign that the Fed is more concerned about inflation than previously thought.
Okay.
They're essentially saying, we're going to tap the brakes on these rate cuts because we think the economy is strong enough to handle it.
And this tapping the brakes is what economists call a hawkish stance.
Right.
But the interesting thing is the Fed also raised its GDP growth forecasts for 2024 and 2025.
Okay.
They're now projecting 2.1% growth in 2025, up from their previous projection of 2%.
Yeah, it does seem counterintuitive at first glance.
Yeah.
You'd think higher growth projections would make them more inclined to cut rates to keep the momentum going.
Right, especially since they've also revised their inflation expectations upward for 2025 and 2026.
That's the real head scratcher.
Yeah.
They're acknowledging that inflation might stick around above their 2% target for longer.
Right.
Yet they're still pulling back on rate cuts.
So what's the logic here? Are they just overly optimistic about their ability to control inflation?
It's a calculated gamble, for sure.
Yep.
They seem to believe that the economy is robust enough to withstand slightly higher inflation without derailing growth. They're betting that they can thread the needle between supporting economic expansion and keeping inflation in check.
But couldn't this backfire? What if inflation proves stickier than they anticipate?
It's definitely a risk,
Yeah,
and one that's making some economists nervous.
right.
They argue that the Fed might be underestimating the persistence of inflation, and that this less accommodative stance could ultimately stifle growth.
So the jury's still out on whether this was the right move.
Exactly. Only time will tell how this plays out.
Yeah.
But one thing is certain.
Yeah.
The markets are taking notice.
Okay.
The dollar is surging as investors flock to U.S. assets attracted by the prospect of higher returns.
Which brings us back to our friend the pound, who's feeling a bit bruised after this whole ordeal.
Yes. The pound-to-dollar exchange rate took a significant hit, dropping to 1.26012 after the Fed's announcement.
Okay.
That's a 0.65% decrease, which might not sound like much.
But it can make a real difference, especially if you're planning a trip across the pond.
Absolutely. A weaker pound means you'll get fewer dollars for your money, making everything from hotels to souvenirs more expensive.
Ouch. Not ideal for those dreaming of a London getaway. But even if you're not jet setting anytime soon, this exchange rate shift can still impact you.
Think about anyone sending money overseas or businesses importing goods from the U.S.
Right.
This fluctuation can affect their bottom line.
So it's a reminder that even seemingly distant financial decisions can have a tangible impact on our lives.
Precisely. And this is just the tip of the iceberg. We haven't even touched on the potential global ripple effects of this Fed decision.
Right, because we're not just talking about the dollar and the pound here.
Right.
This has the potential to trigger a chain reaction across the entire global financial system.
And that's where things get really interesting. The U.S. economy is like a giant ship in the global financial sea. When it changes course, other ships have to adjust their sails.
And right now, it feels like the Fed is steering towards less choppy waters, leaving other central banks to navigate their own rough seas.
Right.
So how are they likely to react to this shift?
It puts them in a bit of a bind, really. They have to balance their own domestic economic conditions with the pressures of a strengthening dollar. If they don't follow the Fed's lead and raise their own rates, they risk their currencies weakening,
Right.
leading to inflation as imports become more expensive.
So it's a delicate balancing act.
Yeah,
They don't want to import inflation, but they also don't want to stifle their own growth by raising rates prematurely.
exactly. It's a game of strategy, watching what the Fed does, assessing their own economies, and trying to anticipate the ripple effects of their decisions.
And with the global economy already facing headwinds like slowing growth in some major economies, this adds another layer of uncertainty.
It certainly doesn't make things easier. The Fed's less accommodative stance could lead to tighter financial conditions globally,
Right.
potentially exacerbating those slowdown concerns.
I'm starting to get a sense of why the pound swooned. It's not just about the direct impact of the dollar strengthening, it's about this broader anxiety rippling through the market.
Precisely. It's a collective holding of breath, waiting to see how this plays out.
Yeah.
But amidst all this uncertainty, it's important to remember that economics isn't a crystal ball.
Right.
We can analyze data, consider different perspectives, and make informed decisions, but we can't predict the future with certainty.
So no guarantees, but we can stay informed and try to anticipate the most likely scenarios.
Right.
And speaking of scenarios, what are some of the factors that could really throw a wrench in the works, even if the Fed's gamble on the U.S. economy pays off?
Well, you always have to factor in geopolitical events,
Right.
trade tensions, political instability.
Yeah.
Those things can have a massive impact on the global economy, regardless of what central banks are doing.
Right. A sudden conflict or a major policy shift could easily derail those optimistic growth projections the Fed is banking on.
Absolutely. And then there are the unpredictable events like natural disasters.
Oh, right.
You can't model for a volcanic eruption disrupting supply chains or a pandemic sweeping the globe.
It's a humbling reminder that even with all our economic models and data analysis, there are forces beyond our control that can completely reshape the landscape.
And that's why staying informed and adaptable is so crucial.
Yeah.
It's not just about understanding interest rates and exchange rates.
Right.
It's about grasping the complexity of the interconnected global system and being prepared for the unexpected.
Okay, so we've got the Fed's surprise move, the dollar surge, and the potential for global ripple effects.
All right.
It's a lot to process, but let's bring it back down to earth for a moment.
Okay.
What does all this mean for our listeners, the everyday folks trying to make sense of their finances?
That's the key question, isn't it? How do we translate these global economic shifts into personal financial decisions?
Exactly. Because at the end of the day, it's about how this impacts our wallets, our investments, our ability to plan for the future. So we've got this swirling storm of global finance. The Fed's doing its thing, the dollar's flexing, and the rest of the world is trying to keep up. But what does it all mean for us here on the ground?
Well, think of it this way. The Fed's less dovish stance, it's like a signal flare going up. It's telling us that they're more confident in the U.S. economy's ability to handle a little rough weather, even if that means higher interest rates and a stronger dollar.
So for someone listening who's thinking about buying a house or taking out a loan, this might not be the best news.
It's something to be mindful of, certainly.
Yeah.
If the Fed continues on this path, we could see those borrowing costs creep up.
Right.
It might be worth exploring locking in those low rates sooner rather than later, depending on your individual circumstances.
But it's not all doom and gloom. A stronger dollar could also mean some benefits for consumers, right? Like cheaper imported goods, maybe?
That's one potential upside. If you're buying products made overseas, you might see some price breaks.
Okay.
And if you're planning a trip abroad, your dollar will stretch further.
Okay, so it's a mixed bag, benefits for travelers and import shoppers, but potential headaches for borrowers.
Yeah.
What about investors? How should they be thinking about this?
This is where it gets really interesting. A hawkish Fed can create opportunities in certain sectors.
Okay.
For example, financials tend to perform well in a rising interest rate environment.
Right.
But on the flip side, growth stocks might take a hit as investors shift towards more value-oriented investments.
So diversification is key as always. Don't put all your eggs in one basket and make sure your portfolio is aligned with your risk tolerance and long-term goals.
Exactly, and don't be afraid to seek guidance from a financial advisor if you need help navigating these shifting tides.
Great point. It's easy to get caught up in the headlines and make impulsive decisions.
Yeah.
But having a solid financial plan and seeking expert advice can make all the difference.
Absolutely.
Yeah.
At the end of the day, knowledge is your most powerful asset. The more you understand about how these global financial forces work, the better equipped you'll be to make informed decisions for yourself and your family.
Couldn't have said it better myself. It's been a wild ride unpacking this Fed decision and its ripple effects, but I think we've managed to shed some light on the complexities and what it all means for our listeners.
It's always fascinating to delve into these topics and see how seemingly abstract financial moves can have such tangible impacts on our everyday lives.
And that's what we're all about here on The Deep Dive, connecting the dots and making these complex issues accessible and relevant.
So to everyone listening, stay curious, keep learning, and don't be afraid to ask questions. The world of finance might seem intimidating, but with a little effort, anyone can grasp the basics and make smart choices.
Exactly. And remember, we're here to help you navigate those choppy waters. So until next time, happy investing, happy traveling, and may your financial journey be ever in your favor.
I will show you how to get the best funding for your startup idea. Let's get started. Here's the deal. If you have an amazing startup idea and need funds to fuel it, we're here to help. Simply send us a video where you explain your idea. Make it clear, concise, and compelling. Hook us in with your passion and vision. Don't forget to include your contact details so investors can reach out directly. This is your chance to shine and get your idea in front of people who can make it a reality. Imagine turning your startup dream into a thriving business. It all starts with that one simple step. So what are you waiting for? Grab your phone, hit record, and let your idea fly. The future of your startup could be just one video away. Remember, be clear, be passionate, and most importantly, be you. We can't wait to see what you've got. Let's get funded now.
in 2000, post-Napster, generally everybody wrote off the recorded music industry, including the investment community. And I didn't mind that chapter because then I got left alone. And actually, I think out of that period, we started to create better art because the pressure wasn't on from the technology to be the most powerful chapter. And then iTunes came in, and iTunes, to Apple's credit, did have a boutique taste mentality about the store, which meant that I think they understood. I can tell you from that period that the artists that came through were of a very high quality because it was encouraged to be boutique. Now, ironically, this chapter has made us more money times 5 than the iTunes chapter and the post-Napster chapter. But an algorithm tells you what you want, not what you might like. And there's a difference between what you want, but with streaming, the downside is you have incredible penetration, and we have hundreds of millions of people around the world. And so that has been very lucrative as a business.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
From our global headquarters in New York, you're welcome to Bloomberg Brief. I'm Menace Cranny. Let's set that agenda. Global risk reassessed as U.S. stocks post their worst Fed day since 2001. Jolted by a hawkish Fed and now a cautious BOJ. Not so fast. President-elect Trump and Elon Musk opposed the proposed funding bill, increasing the likelihood of a government shutdown. Micron plunges as nearly $1 billion miss on the revenue forecast due to sluggish demand for smartphones and PCs. Good morning. Context for you. We have a small bounce back by 0.5% on the NASDAQ. It was crushed yesterday by 3%. There was a ransacking of risk. What you saw was $1.6 trillion of equity market value wiped out. It was your opportunity, some would say, to buy the dip. The Russell was crushed by 5%. The killer blow, according to Julian Emmanuel at Evercore, was, can you rule out a rate hike in 2025? We don't roll anything completely in or completely out. And that was the moment that really the market swooned. Roll it over, have a look at the bond market. I would say that a depth charge went off in the bond market yesterday. You broke through 450 on the 10s. The bears were rewarded. The vigilantes are still in abeyance. This was a close call to actually cut by 25 basis points with dissent. That was the line from Jay Powell. So right now, we're treading water at 452, but we're in a new paradigm, perhaps even a new phase of bond rates. Fed officials capped 2024, as I say, with a third straight interest rate cut and a strong signal that inflation concerns, they're back. Chair Powell discussed the central bank's path forward.
I think that the slower pace of cuts for next year really reflects both the higher inflation readings we've had this year and the expectation that inflation will be higher. You saw in the SEP that risks and uncertainty around inflation we see as higher. Nonetheless, we see ourselves as still on track to continue to cut.
What could blow them off track to cut? Adam Posen usually has the answers to that. Adam, good to see you from the Peterson Institute, International Economics. Look, you've been bang on the money, Adam. Every time you've been with Danny and I, you said they won't make the cuts that they promised this year, and you fear that we will be hiking next year. Given what you heard yesterday, and there are many juxtapositions in that presentation, yeah. Do you think we're closer to a significant pause, or even the hikes, the potential for hikes is even more real now?
I think, thanks, Menace, and I appreciate the call out. I mean, for 6 months, I've been talking with you about this, more than 6 months, this likelihood. I think we are about to come to a significant pause. They may get in one more cut come February, March, but by then they start worrying about the budget, about tariffs, about migration issues, all of which they could have seen coming. More importantly, the underlying strength of the U.S. economy, which they got wrong as recently as the September forecast, again, was pretty evident for all to see. So they have a choice. They can either ratify that and say productivity growth is up in some sustained way, in which case they have to keep moving up the 10-year dot, or they can say this is a blip, in which case they have to explain why it's going to slow down. Right now, they're not doing either, so the markets are correctly pricing in a wide range of outcomes. In the end, I think they'll be hiking by June.
Hiking by June. Let's just square away very briefly. Do you think we are in a growth paradigm shift of productivity before we move on?
Yes, I think it's worth gambling on. And that would be the one good argument that the Fed could make for being in a more cutting mode, is saying we're getting a given amount of growth higher for a given amount of inflation. We're getting readings on productivity that are, of course, variable, but on average are up. But then they have to explain why. And if they want to say AI, again, that's arguable, but they have to make a call. And they so far have been unwilling to make a call.
Well, there was a productivity growth in the 90s, and you will know the precision better than I, but it was a nearly 3% uplift in productivity growth in the early 90s. Forgive me for not having the precise number. They are thinking about tariffs, Adam. Some are already thinking about tariffs. Highly conditional estimates. That was the words from Powell. So there are those on the Fed who are listening to the background music, as I'm calling it, from the ballroom at Mar-a-Lago. But should they be much more forward-thinking in their models on what that will do to PCE, sir?
I think they got to be thinking, Manus. I like the ballroom image because they're dancing while the world is in a mess. I think they've got to be thinking about two issues. The first is, do they consider tariffs inflationary, or do they consider tariffs a one-off price shock? And if it's a one-off price shock, then they say, well, the right response is not to react until we see the second round of inflation. But in the context we're in, with inflation above target, they haven't raised the target. It stayed there for a long time. The risks are upside. I'm not sure they can do that. But that's the first choice. And then the second choice is the more calibration of rough order of magnitude. How much inflation do you think you're going to get? And if the Trump administration goes ahead with the tariffs, they'll insist, well, you're going to have the dollar go up, and that will at least partially offset the inflation. And last time, we didn't have so much inflation. So there will be a debate, and there will be political pressure for them not to overreact to the tariffs. I think they should treat it as an inflationary shock given the context, and accept that this level of tariff uncertainty is higher than last time. The other thing, though, Manus, which you and I spoke about when I was on last month kindly, was the issue of migration. And again, that's a pure negative supply shock. Now, they could ease into that if the migration flow is cut, or if there's mass deportations. But it's definitely inflationary if that happens.
But then it becomes a debate of whether the migration, and we'll know more about the policy, whether the migration supersedes the, as everybody's saying to me, the tactical deployment of tariffs. Exactly. But when I look at the narrative that's levied against Mexico and Canada, and I look at his rhetoric around tariffs, do you think this time around it will be tactical tariffs or something more enduring?
I think there's going to be enduring changes to the Mexico and Canada economic relationships. The tariffs may not be the end unto themselves, and in some ways I hope they're not. But I think there are going to be changes to make Mexican exports into the U.S. less competitive, to deter Chinese and other investment into Mexico, to raise the rules of origin requirement, to put more burdens on Mexico. And whether that's tariffs or other restraints, it's going to erode Mexican competitiveness. One of the things I did not call right, and I've been surprised by, is the extent to which Mexican markets are up this year, in the context where they have so many issues and where the U.S. relationship is likely to get more fraught. Canada is definitely up for negotiation and should be seen that way. So I think we have to separate the China and the Mexico tariffs from everything else that's going on the tariff front.
I want to get to the Bank of Japan, Adam, because the market, the yen selling off, people are now, Ueda has not verbalized what the market was wanting to hear, which was a hike in January. To the extent that this puts him in conflict with the diet, we can debate. But when you look at Japan and you look at the Bank of Japan, are we now firmly in the error zone in regards to guidance?
I think I think this is the first misstep in a while. I think they've played it carefully up till here, which was fine. But they set things up and the economic data was clearly on a path for a hike. Given the exchange rate situation, there shouldn't be any hesitation from the Ministry of Finance of the diet on this basis. The economy has proven rather resilient in a good way, which is great. So it's hard to see. I mean, obviously, there's a great deal of uncertainty and weakness around the elected government, as in so many places right now. But it is hard to see why right now they're slowing down the guidance in Japan.
I find it interesting that you talk about Japan, despite Nippon Steel being blocked, will benefit from, as you say, Fortress America. Just give me some context around that.
Yeah, I mean, the Nippon Steel is a big deal. It's a negative signal for Japanese and other allied investors in the U.S. But if we think about Trump's goal as creating a wall of tariffs and other restrictions around the U.S., forcing production for the U.S. market into the U.S., investment from abroad, Japan and a few other countries are positioned to benefit from that. They're clearly allied with the U.S. in a national security sense. As a result, they're willing to give up some of their relationship economically with China to stay on the inside of the U.S., and then they can ideally grow with the U.S. as the U.S. proceeds. And so, unfortunately, it looks like Trump is going to be still holding out things like Nippon Steel from that kind of relationship. But Japan potentially and this was Nippon Steel's idea, was that they would get inside the U.S. market. The U.S. Steel was just to be a foothold in the U.S. market, and then they would grow with the U.S. And so I still think that's the direction of travel for Japan, possibly UK, possibly Australia and Canada, possibly Korea. But I think it relies on both the national security relationship and the U.S. being willing to accept investment from close allies and democracies as though it is investment from the U.S. And they should.
This is the point that you make, Adam, and if we can just square this away, we're nearly out of time, which is the roadmap to de-escalation of tariffs is not to get on a plane, as Justin Trudeau did in the initial point, but it is about FDI into the United States of America. You saw it from SoftBank. So is that the soft power lever to de-escalate tariff aggression from the United States, Trump 2?
I think the short answer is yes. That's what worked in the 80s with Toyota, Honda, and others, Kikoma, and all kinds of Japanese companies investing in the U.S. In an allied relationship, that'll work. When you're dealing with China or India or countries with whom Trump has more friction, the U.S. has more friction, that FDI acceptance isn't as clear, so you don't have that avenue out.
Okay, succinctly put. Adam, thank you so much for joining me this morning. That's Adam Posen of the Peterson Institute for International Economics. Coming up on the show, Washington is about to run out of federal funding. You got it. We're looking at a shutdown, and President-elect has complicated the matter. We'll bring you the latest on politics next on Bloomberg.
Is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have take two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
European countries need to think, do you want to compete as a small country or do you want to compete as Europe? I don't think they have a choice because the US and China have already started the race and Europe needs to follow. There isn't a European company in the top 20 largest firms in the world. That is a problem.
what does it mean for individual countries within Europe?
You can have more control and less growth, or you can have less control and more growth. If countries trust each other more and they build more European champions rather than each country having its own national champion, growth is going to be better, productivity growth is going to be better, the welfare is going to be better. But there is going to be less control at the national level. So right now, each European country wants to have its own telecom company, its own couple of large banks,
Its own bank.
its own large energy companies. And the question is, are you willing to surrender some of this control to European firms, which are going to be more productive, but you are going to have less control at the national level?
It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, the China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, the China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
It's Bloomberg Brief. I'm Menace Cranny in New York. Some headlines coming through from President Putin. He is talking, this is his one of his annual address where he takes questions from open mic, as you can see there. But what he has said, if I meet Trump, surely we will have things to discuss. He is ready to meet with Donald Trump. So these are just a couple of the lines. I haven't spoken to him in over 4 years. This is Putin said at his annual news conference. And as of today, there's been no contact with Trump team on the envoy visit. So that's according to IFX. Always an interesting marathon of conversation with President Putin there. Okay, time is running out in Washington to renew its federal funding, and the president-elect Donald Trump has come out in opposition of the proposed stopgap. In a joint statement with his running mate, J.D. Vance, Trump said this: increasing the debt ceiling is not great, but we'd rather do it on Biden's watch. If Democrats won't cooperate on the debt ceiling now, well, what makes anyone think that they would do it in June during our administration? So let's have that debate now. Mike Shepard is with me around the desk. Shep, good to see you this morning. Good to see you. So not only 24 hours ago was it Elon Musk who torched this continuing resolution, Trump jumped on, and then Trump said, I want the debt ceiling raised as well. It takes months to negotiate the debt ceiling. So is this a lever to negotiate or a real ask?
I think this is a real ask. As you look at this from Donald Trump's perspective, you're thinking ahead to the first 100 days of your term. And what you want is to have the lane cleared. You want to be able to work right away on that border legislation. You want to be able to get right away to other things like tax cuts that he has promised voters across the country. People are expecting action. They want to see change. And if he has to deal with the debt limit, that will be an exhausting and time-consuming process. As we remember the way it was back in June 2023, we came within a few days of historic default, and that was after months of negotiation. Now, this spending bill that we're talking about, that too has been the subject of weeks, if not months, of negotiation, and we've seen a lot of provisions added to this bill just to try to get enough support for it. That includes disaster relief, it includes aid for farmers, it even has policy provisions like restrictions on outbound investment by U.S. firms in China. Now, all those things would go out the window if Trump gets his way. He wants a clean bill plus this debt limit increase.
As he said, he wants a streamlined bill. He wants to keep the aid for farmers, for natural disaster, but he wants to jettison everything that, that the Democrats want. He has threatened his Congress. He basically said any representative out there who doesn't vote to raise the debt ceiling is stupid and should and will be primaried. Now, this raises a much bigger issue about how you govern. You have the three, you have the three-line, the presidency, you have the Senate, and you have the Congress next year. But this is a billionaire who's torching policy in Elon Musk, and you have the president really warning, I'm going to rule by a wrought iron You know, there's no carrot in this, is there? It's all stick.
There really isn't a carrot in this for anybody in Congress when they're dealing with Donald Trump on this issue. He is exercising what we see as raw power in his position as really the de facto head of the Republican Party. And he is able to do this thanks to the support of Elon Musk, who helped bankroll his campaign, but also a lot of other Senate campaigns and congressional campaigns as well. So we're seeing that clout being put to use. Now, the question is, how much do lawmakers actually heed this? Remember,
I would say, how long will lawmakers put up with this?
Well, great question. And we're going to find out within the next 48 hours whether they're able to very quickly renegotiate this whole thing and then try to get it done on time. They have a midnight Friday deadline to finish. Otherwise, a partial shutdown commences on Saturday morning. So this is high stakes. There is no time left. There was a lawmaker interviewed last night from Capitol Hill who aired on another network who said, gee, I wish that the President-elect had made this request a few weeks ago so that we could have factored it into the negotiation. But in a way, Trump, with this brinkmanship, is really putting the heat on Congress.
But this is classic Trump brinkmanship. It's the way of 2025. Let's just square it up very, very quickly. You've got Vivek Ramaswamy and you have Elon Musk hiring for the Department of DOGE. What do we know about that so far?
Yes, we had a great scoop last night looking into this and turning up that they have already hired about 10 people to work on this initiative with the hope of trying to cut government spending radically. They have a vision through this Department of Government Efficiency. It's important to note that it is not a government, it is not an agency, and the exact makeup of it for the coming year is still unclear. We don't know if it will be a federal entity or a private, maybe a 501(c)(3). But interesting that Elon Musk has tapped a couple of people from his universe, from Boring Co. He has an executive from there who's helping lead the hiring effort. And we also have the former U.S. Chief Technology Officer, Michael Kratsios, who was in the Trump administration, is now working with Elon Musk on this effort. So it's coming together quickly. We don't know exactly who's paying the salaries. They do have office space for now in the SpaceX building, not too far from the White House. So they will have access to the halls of power and certainly, as we see from yesterday's events, Donald Trump's ear.
Okay, Shep, thank you so much. That's Michael Shepard there with the very latest on the political stories from Washington. And don't miss our interview with the Secretary of State, Antony Blinken. That's at 8:15 a.m. Eastern, 1:15 p.m. in London. Earnings, yes, there still are earnings, and it's from the tech side. Look at this, Micron Technology plunging in the pre-market. This is the largest U.S. maker of computer memory chips, posting disappointing revenue forecast by sluggish demand for smartphones, personal computers, everything that we use. Jake Silverman is a semiconductor analyst for Bloomberg Intelligence, joins me around the desk. Wow, I mean, that is a brutal reaction. Just how far off the estimates was Micron? What injured them?
Yeah, it was about 12% off their guidance, or their guidance was 12% off consensus estimates on sales. So, yeah, it really is, it comes down to an inventory correction, maybe temporary in PCs and smartphones, and it was really a result of customers building up inventory over the last several quarters ahead of anticipated price increases, and now that's starting to have an impact.
Just looking at what some of the analysts are putting out this morning, Morgan Stanley, they've got an equal weight on it. They say the decline was due to NAND flash memory chips. What does that tell me about the state of end demand out there?
Yeah, so there's a little bit of a difference between NAND and DRAM. Right now, what's happening with DRAM is that they're getting a lot of demand specifically for AI-related products. You can think about high bandwidth memory, high-capacity DIMMs, or DRAM modules. And there was an AI story in NAND as well with enterprise solid-state drives, but even that seems to be moderating in the meantime. So there's definitely a little bit of a dichotomy.
So look, you had the Broadcom phenomenal performance last week, at one stage over 2 days, up 38%. So you had this massive move with Broadcom. NVIDIA was giving a little bit back. Is there a shifting landscape in terms of the demand for AI products and chips and who's delivering them?
Yeah, look, so I mean, Micron supplies, for their high bandwidth memory, they supply into NVIDIA's GPUs as well as ASICs, where Broadcom is more influential. So, you know, when it comes to AI, really, Micron is a little bit more agnostic in terms of who's actually benefiting from them in terms of the compute processor. And then when we think about other areas like high-capacity DRAM modules and LP5, which is other products that they serve into AI, again, they're pretty agnostic. As long as there's demand for AI infrastructure, they'll benefit from that.
Jake, thank you so much. Context there from Jake Silverman on Micron. The stock really under pressure this morning. Coming up, a slew of economic data, plus the interview with the Secretary of State, Antony Blinken. That is an interview you do not want to miss, right here on Bloomberg.
Asia is at the forefront of some of the world's biggest stories. I'm Chevrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, only on Bloomberg.
Good morning. Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
You're watching the close.
Welcome to Balance of Power.
This is Bloomberg.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Rio de Janeiro, Brazil, and this is Bloomberg.
Quick look at what's ahead for the rest of your day. The Bank of England will announce their rate decision at 7 a.m. Eastern. Secretary of State Antony Blinken speaks to Bloomberg's David Gura. That is at 8:15 a.m. You don't want to miss that conversation. And we have a slew of economic data then. Core PCE, GDP, personal consumption, and the jobless claims, all at 8:30 a.m. Undoubtedly, one market, I mean, risk premia was blown apart yesterday, really on the back of that hawkish cut from the Fed. But the yen bears are having a party. Look at this. The past 4 days, I can tell you, there's a sell-off in the yen. We've just had a conversation with Mark Dowding. Very definitely we're at the start, potentially, of policy error, as Ueda basically said, I need to wait until the spring and watch momentum before he makes up his mind on what happens with rates in Japan. Yen under pressure. Good morning from Bloomberg.
about quantum computing? People talk about that. Is that something that I should be looking at investing in?
I've made a lot of mistakes, betting on these new technologies like AR, VR turns out to be.
Another thing that startups need to look for is a market that is either started to undergo or is soon going to undergo exponential growth. I think this is actually related to one of the biggest mistakes investors make when evaluating startups. Investors always say, well, what's your growth rate? We care about the growth rate. Investors will forgive smallish revenue today if it's growing quickly. For some reason, people don't think about markets this way. But if you think about the most important startups, they are the ones that I start in small markets that are growing very, very quickly. 11 years ago, the market for iPhone apps was $0. It's now huge. And I think if you only think about the TAM today, you'll make a big mistake. What you really want to do is identify a market that's going to grow every year and be able to ride that up elevator.
Welcome to the digital age. Are you struggling to stand out here? Don't worry. Meet Blue TV, who is your digital superhero.
Blue TV is a multi-purpose online media network that also provides digital marketing services. We are based in Islamabad, Pakistan. We are expert in creative marketing, social media and digital marketing, search engine optimization, web design, page rank, and SERPs, video editing, recording and production.
So, what are you waiting for? Pick up the phone and call or WhatsApp Blue TV on given number, or visit our Facebook page at facebook.com/blue.online.tv.
With Blue TV, your business growth will be skyrocketed.
I want a bank that shows me what I spend instantly.
We're Monzo. Give us a go. See?
I want a bank that can help me budget for the things I need, like a new leather jacket for Bingo.
We can do that.
Bingo's my cockapoo.
Hi, Bingo.
It's a real faff to sign up.
It takes less than 10 minutes.
Race you.
You're on. Time's up. How'd you get on?
It's a draw.
Is it? We hear you, Bingo. You make Monzo Monzo.
My general advice is continue to seek out companies or people that are maybe one stage or two stages ahead of you. And I think this is generalizable to not just to startups, but anyone seeking fast growth in their own professional lives, in their careers too. What does greatness look like? Try to seek out people who've been there, done that before, and then try to not connect with one, but try to interview 3, 5, 10 people to see what is a general pattern of greatness that look like that will get you to the next level of the company, next stage, maybe a year, 12 months from now, 24 months from now. Seek out people who kind of went down that path a few times. Then you'll start to find this pattern that start to emerge. What are things that you need to have 12 months from now, 24 months from now that you currently don't have? Then try to build a path towards that. Almost like Amazon's or Jeff Bezos' mantra of working backwards. Think about what your end game or next stage look like, and then figure out your steps to getting there, and who do you need to work with, upgrading or coaching your existing team or recruiting from somewhere else to really level your leadership. Because ultimately, the job of a CEO is to do 3 things, right? One is get the strategy right for your company, making sure it's executed, get the right teams onboarded, getting the resources, whether it be fundraising or allocating your resources. So it's strategy, people, or team, figuring out how you need to navigate those things to get to the next level.
I will show you how to get the best funding for your startup idea. Let's get started. Here's the deal. If you have an amazing startup idea and need funds to fuel it, we're here to help. Simply send us a video where you explain your idea. Make it clear, concise, and compelling. Hook us in with your passion and vision. Don't forget to include your contact details so investors can reach out directly. This is your chance to shine and get your idea in front of people who can make it a reality. Imagine turning your startup dream into a thriving business. It all starts with that one simple step. So what are you waiting for? Grab your phone, hit record, and let your idea fly. The future of your startup could be just one video away. Remember, be clear, be passionate, and most importantly, be you. We can't wait to see what you've got. Let's get funded now.
After the Fed's latest announcement, and we're going to dive deep into why.
Okay.
We've got a fresh analysis from Pound Sterling Live, aptly titled,
Right.
Pound to Dollar Rate Swoons After Fed Dials Back Rate Cut Ambitions.
Mm-hmm.
So what's the connection between the Fed and the pound's sudden dip? And more importantly, what does it mean for you?
Yeah, it's a fascinating example of how interconnected the global financial system really is.
Right.
What seems like a purely American monetary policy decision can ripple out and impact currencies across the globe.
Okay, so let's start with what the Fed actually did. They cut interest rates by 25 basis points. But here's the catch.
Okay.
The markets were expecting a more aggressive move.
Right, and that's why this seemingly small cut sent such a shockwave.
Mm.
Remember back in September when the Fed projected 4 rate cuts for 2025?
Yeah.
Well, now they're only anticipating 2, totaling a 50 basis point reduction.
Oh, wow.
This less accommodative stance, combined with only 1 dissenting vote to keep rates unchanged, really threw people off.
So it's not just the rate cut itself, but the signal it sends about the Fed's thinking, right?
Exactly. The markets are reading this as a sign that the Fed is more concerned about inflation than previously thought.
Okay.
They're essentially saying, we're going to tap the brakes on these rate cuts because we think the economy is strong enough to handle it.
And this tapping the brakes is what economists call a hawkish stance.
Right.
But the interesting thing is the Fed also raised its GDP growth forecasts for 2024 and 2025.
Okay.
They're now projecting 2.1% growth in 2025, up from their previous projection of 2%.
Yeah, it does seem counterintuitive at first glance.
Yeah.
You'd think higher growth projections would make them more inclined to cut rates to keep the momentum going.
Right, especially since they've also revised their inflation expectations upward for 2025 and 2026.
That's the real head scratcher.
Yeah.
They're acknowledging that inflation might stick around above their 2% target for longer.
Right.
Yet they're still pulling back on rate cuts.
So what's the logic here? Are they just overly optimistic about their ability to control inflation?
It's a calculated gamble, for sure.
Yep.
They seem to believe that the economy is robust enough to withstand slightly higher inflation without derailing growth.
Mm.
They're betting that they can thread the needle between supporting economic expansion and keeping inflation in check.
But couldn't this backfire? What if inflation proves stickier than they anticipate?
It's definitely a risk,
Yeah,
and one that's making some economists nervous.
right.
They argue that the Fed might be underestimating the persistence of inflation, and that this less accommodative stance could ultimately stifle growth.
So the jury's still out on whether this was the right move.
Exactly. Only time will tell how this plays out.
Yeah.
But one thing is certain.
Yeah.
The markets are taking notice.
Okay.
The dollar is surging as investors flock to U.S. assets attracted by the prospect of higher returns.
Which brings us back to our friend the pound, who's feeling a bit bruised after this whole ordeal.
Yes. The pound-to-dollar exchange rate took a significant hit, dropping to 1.26012 after the Fed's announcement.
Okay.
That's a 0.65% decrease, which might not sound like much.
But it can make a real difference, especially if you're planning a trip across the pond.
Absolutely. A weaker pound means you'll get fewer dollars for your money, making everything from hotels to souvenirs more expensive.
Ouch. Not ideal for those dreaming of a London getaway. But even if you're not jet setting anytime soon, this exchange rate shift can still impact you.
Think about anyone sending money overseas or businesses importing goods from the U.S.
Right.
This fluctuation can affect their bottom line.
So it's a reminder that even seemingly distant financial decisions can have a tangible impact on our lives.
Precisely. And this is just the tip of the iceberg.
Oh.
We haven't even touched on the potential global ripple effects of this Fed decision.
Right, because we're not just talking about the dollar and the pound here.
Right.
This has the potential to trigger a chain reaction across the entire global financial system.
And that's where things get really interesting. The U.S. economy is like a giant ship in the global financial sea. When it changes course, other ships have to adjust their sails.
And right now, it feels like the Fed is steering towards less choppy waters, leaving other central banks to navigate their own rough seas.
Right.
So how are they likely to react to this shift?
It puts them in a bit of a bind, really. They have to balance their own domestic economic conditions with the pressures of a strengthening dollar. If they don't follow the Fed's lead and raise their own rates, they risk their currencies weakening,
Right.
leading to inflation as imports become more expensive.
So it's a delicate balancing act.
Yeah,
They don't want to import inflation, but they also don't want to stifle their own growth by raising rates prematurely.
exactly. It's a game of strategy, watching what the Fed does, assessing their own economies, and
Yeah.
trying to anticipate the ripple effects of their decisions.
And with the global economy already facing headwinds like slowing growth in some major economies,
Right.
this adds another layer of uncertainty.
It certainly doesn't make things easier. The Fed's less accommodative stance could lead to tighter financial conditions globally,
Right.
potentially exacerbating those slowdown concerns.
I'm starting to get a sense of why the pound swooned. It's not just about the direct impact of the dollar strengthening, it's about this broader anxiety rippling through the market.
Precisely. It's a collective holding of breath, waiting to see how this plays out.
Yeah.
But amidst all this uncertainty, it's important to remember that economics isn't a crystal ball.
Right?
We can analyze data, consider different perspectives, and make informed decisions, but we can't predict the future with certainty.
So no guarantees, but we can stay informed and try to anticipate the most likely scenarios.
Right.
And speaking of scenarios, what are some of the factors that could really throw a wrench in the works, even if the Fed's gamble on the U.S. economy pays off?
Well, you always have to factor in geopolitical events,
Right.
trade tensions, political instability.
Yeah.
Those things can have a massive impact on the global economy, regardless of what central banks are doing.
Right. A sudden conflict or a major policy shift could easily derail those optimistic growth projections the Fed is banking on.
Absolutely. And then there are the unpredictable events like natural disasters.
Oh, right.
You can't model for a volcanic eruption disrupting supply chains or a pandemic sweeping the globe.
It's a humbling reminder that even with all our economic models and data analysis, there are forces beyond our control that can completely reshape the landscape.
And that's why staying informed and adaptable is so crucial.
Yeah.
It's not just about understanding interest rates and exchange rates.
Right.
It's about grasping the complexity of the interconnected global system and being prepared for the unexpected.
Okay, so we've got the Fed's surprise move, the dollar surge, and the potential for global ripple effects.
All right.
It's a lot to process, but let's bring it back down to earth for a moment.
Okay.
What does all this mean for our listeners, the everyday folks trying to make sense of their finances?
That's the key question, isn't it? How do we translate these global economic shifts into personal financial decisions?
Exactly. Because at the end of the day, it's about how this impacts our wallets, our investments, our ability to plan for the future. So we've got this swirling storm of global finance. The Fed's doing its thing, the dollar's flexing, and the rest of the world is trying to keep up. But what does it all mean for us here on the ground?
Well, think of it this way. The Fed's less dovish stance, it's like a signal flare going up. It's telling us that they're more confident in the U.S. economy's ability to handle a little rough weather, even if that means higher interest rates and a stronger dollar.
So for someone listening who's thinking about buying a house or taking out a loan, this might not be the best news.
It's something to be mindful of, certainly.
Yeah.
If the Fed continues on this path, we could see those borrowing costs creep up.
Right.
It might be worth exploring locking in those low rates sooner rather than later, depending on your individual circumstances.
But it's not all doom and gloom. A stronger dollar could also mean some benefits for consumers, right? Like cheaper imported goods, maybe?
That's one potential upside. If you're buying products made overseas, you might see some price breaks.
Okay.
And if you're planning a trip abroad, your dollar will stretch further.
Okay, so it's a mixed bag, benefits for travelers and import shoppers, but potential headaches for borrowers.
Yeah.
What about investors? How should they be thinking about this?
This is where it gets really interesting. A hawkish Fed can create opportunities in certain sectors.
Okay.
For example, financials tend to perform well in a rising interest rate environment.
Right.
But on the flip side, growth stocks might take a hit as investors shift towards more value-oriented investments.
So diversification is key as always. Don't put all your eggs in one basket and make sure your portfolio is aligned with your risk tolerance and long-term goals.
Exactly. And don't be afraid to seek guidance from a financial advisor if you need help navigating these shifting tides.
Great point. It's easy to get caught up in the headlines and make impulsive decisions.
Yeah.
But having a solid financial plan and seeking expert advice can make all the difference.
Absolutely.
Yeah.
At the end of the day, knowledge is your most powerful asset. The more you understand about how these global financial forces work, the better equipped you'll be to make informed decisions for yourself and your family.
Couldn't have said it better myself. It's been a wild ride unpacking this Fed decision and its ripple effects, but I think we've managed to shed some light on the complexities and what it all means for our listeners.
It's always fascinating to delve into these topics and see how seemingly abstract financial moves can have such tangible impacts on our everyday lives.
And that's what we're all about here on The Deep Dive, connecting the dots and making these complex issues accessible and relevant.
So to everyone listening, stay curious, keep learning, and don't be afraid to ask questions. The world of finance might seem intimidating, but with a little effort, anyone can grasp the basics and make smart choices.
Exactly. And remember, we're here to help you navigate those choppy waters. So until next time, happy investing, happy traveling, and may your financial journey be ever in your favor.
Just raising their inflation expectations, I think we're going to see a rocky ride in the markets.
Jim, enjoyed it. Looking forward to covering this with you. Jim Bianco of Bianco Research. And Jim, thanks for everything in 2024. We'll see you no doubt in early 2025. We went through this yesterday, the year-to-date moves in foreign exchange, and pinpointed what's been developing in emerging markets, not just over the past week, but through much of this year. Moves of more than 20% against the Brazilian currency. Moves of 21% against the Argentinian currency. Moves of close to 17% against the Mexican peso. That's painful for a lot of those countries.
It's painful, and it potentially could even alter and inhibit how much they can drop rates to stimulate their economies economically. Because if they do see further depreciation of their currencies, then when they import in any kind of dollar-based or dollar-priced asset, that is going to be an inherent inflationary force. It kind of creates a real spiral for a lot of these economies.
DXY just a little bit softer on the session at the moment, pulling back from 108 at 107.90. Just amazing. We're negative by about 1/10%. With an update on stories elsewhere this morning, let's get to your Bloomberg Brief with Yahira Hackers. Hey, Yahira.
Good morning, John. House Majority Leader Steve Scalise says the stopgap funding measure released Tuesday is dead. Scalise's announcement comes after President-elect Donald Trump came out against it and threatened to oust fellow Republicans who don't meet his demands. That includes raising the debt limit along with the legislation. If lawmakers can't reach a new agreement, the government could shut down Friday night at midnight. Meanwhile, Micron shares are plunging down 15% in the pre-market. The largest U.S. maker of computer memory chips announced earnings and revenue guidance that missed analyst estimates. While orders remain strong for components used for artificial intelligence, it still hasn't seen a pickup in demand from makers of phones and PCs, two markets that make up the majority of its chip volume. Still, Micron CEO said he expects a return to growth in the second half of the fiscal year. And AT&T and Sweetgreen are the latest companies telling employees to come into the office more often starting next year. The telecom giant will require U.S. corporate employees to be in the office 5 days a week, while the salad chain is moving to 4 days a week for the few hundred support staff who don't work at the restaurants. Employees at both companies currently go into the office about 3 days a week. Must be nice. That's your Bloomberg Brief. John?
I feel the same way. And every time I hear these stories, and thank you, Yahira, I think the same thing. Where have they been for the last 12 months?
I understand. At the same time, have you seen these studies showing that people who actually offer hybrid work get a lot more applicants to work at their companies? So I just wonder, at what point do you actually just say, look, the norm is now going into the office?
Okay.
I'm trying to be generous
I
because
hear
it's like, at a certain point, it's just sour grapes on my part, having to,
Sour grapes on my part,
I mean,
too.
100%. This is just personal, and I want to be a bigger
to still be
person.
in bed,
I know.
TV screen behind me as a headboard,
My
sort
goal
of sit up.
for 2025 is to be a bigger person.
Good for you, Bramo. Let's see how that works out. Up next on the program, Trump pushes back on the budget.
We got to get this done because here's the key. By doing this, we are clearing the decks and we are setting up for Trump to come in roaring back with the America First agenda.
That conversation up next, live from New York City this morning. Good morning.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg, context changes everything.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
There is this real momentum from Wall Street. We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Francis Donald from RBC joining us on the program a little bit later, echoing what Lisa was talking about earlier on this hour. There is no consensus at the Federal Reserve. There is no conviction in this FOMC. So trying to decipher their perspective/bias as a whole is probably a fool's errand. Something you were making a point of about 19 minutes ago.
Essentially, a couple months ago, everyone was talking about the Fed put being back, and that essentially put a floor under valuations going forward was a tailwind at a time where downside growth shocks would be met with potentially a Fed rate cuts. If you have FOMC members that are concerned about the potential for inflation from future policies that have not been put out there yet, that might not be the bias anymore, and that Fed put is gone.
Certainly questioning the easing bias in the last 24 hours, attempting to bounce back from the biggest one-day loss on the S&P since August. We're up by 0.4% on S&P 500 futures this morning. Under surveillance this morning, Trump pushing back on the budget.
Vivek and I talked last night about almost midnight, and he said, look, I get it. He said, we understand you're in an impossible position. Everybody knows that. Remember, guys, we still have just a razor-thin margin of Republicans, so any bill has to have Democrat votes. They understand the situation. They said, it's not directed to you, Mr. Speaker, but we don't like the spending. I said, guess what, fellas? I don't either. We got to get this done because here's the key. By doing this, we are clearing the decks, and we are setting up for Trump to come in roaring back with the America First agenda.
So here's the latest this morning. President-elect Donald Trump opposing the stopgap funding bill Speaker Mike Johnson and Democrats presented on Tuesday to avoid a government shutdown. Trump pushing for lawmakers to increase the debt ceiling, writing on Truth Social, the most foolish and inept thing ever done by congressional Republicans was allowing our country to hit the debt ceiling in 2025. It was a mistake and is now something that must be addressed. Joining us from the nation's capital, Bloomberg's Tyler Kendall. Tyler, what's the latest this morning?
Yeah, good morning, John. Bloomberg News reporting that Vice President-elect J.D. Vance spent last night on Capitol Hill negotiating with House Speaker Mike Johnson. Now, of course, this all started to unravel yesterday with the initial criticism by Elon Musk and Vivek Ramaswamy, and then was cemented when President-elect Donald Trump voiced his opposition. So the original bill would have funded the government through mid-March. Interestingly enough, Trump says that he does support some supplemental funding in a new deal, notably disaster assistance and economic assistance for farmers. But he ultimately said that the current bill had way too many provisions in it that he thought would help Democrats politically. But as you alluded to there, he didn't just oppose this bill. He went 2 steps further. One, he told Republicans that they need to raise the debt ceiling, of course, a politically fraught issue that he admits he doesn't want to have to deal with during his term. So he'd like to see that addressed now. And second, he threatened any Republican who came out against that idea that he would support a primary challenge against them. It actually echoes a similar threat that we heard earlier this week that he made against Senate Republicans who might be thinking of voting against his nominations. He says for political reasons. But John, if I've learned anything from living here in Washington, it's that when one election ends, another election truly does start. And Republicans are paying close attention to this because in 2026, the next midterm elections, Republicans are going to be defending 20 Senate seats. That is about double the amount that they just had to defend in the 2024 elections that ultimately helped them flip that chamber. So that all just goes to say that there are going to be many more vulnerable Republicans, kind of a captive audience, if you will, who will be listening to these threats from the president-elect. over the next 2 years.
I had to be thinking about this children's book, If You Give a Mouse a Cookie, when I was reading some of the negotiations, because essentially Mike Johnson proposed and added an additional $10 billion for farmers, and then all bets were off. It was to the races, and the Democrats added in a pay increase for members of Congress, new regulations for health plan administrators, the RFK Stadium, moving it to Washington, D.C., and then the gates were open. I just wonder how much this highlights how splintered the Republicans are and how difficult it's going to be to get through some of the proposals that the Trump administration has put forward.
Exactly. This is actually setting up a conversation that's going to show that it's going to be difficult in the next Congress. We know that Trump is asking Congress to prioritize 3 things that he wants to see them work on right off the bat come 2025. That's immigration, energy, and tax cuts. And it's opening this conversation, particularly from more conservative members of the House Freedom Caucus, and they're saying that if there's going to be tax cuts, there also needs to be spending cuts. Because at the end of the day, while we are talking about too many provisions in this bill, that originally came out, and President-elect Trump taking issue with some of them, notably that members of Congress would have gotten a pay raise. The initial frustration with this bill from many Republicans was that there wasn't enough pay-fors to offset all of this spending, and that's already starting to bubble up when we talk about these conversations for next year, particularly that Trump has proposed a litany of tax cuts that one Bloomberg analysis shows that if they were all implemented, including making permanent some of the 2017 tax cuts, but also some new proposals like eliminating tax on tips, overtime, Social Security, that would amount to $10.5 trillion being added to the deficit over 10 years. That's something that Republicans are going to have to grapple with in the next Congress.
Tyler, just quickly here, do we have a sense of whether Donald Trump would have torpedoed this without Elon Musk coming out first and really being angry about it?
Right. So I actually was talking to one Republican strategist about this who said that he doesn't necessarily blame Elon Musk here, since he's the one that's tasked with cutting government spending. And perhaps the easiest way to do that is to cut the spending that hasn't happened yet. Now, Republican Congressman Andy Barr, a Republican from Kentucky, came out yesterday and told reporters that his office was flooded with calls from constituents saying that they had seen Elon Musk's posts. And that is what ultimately propelled him to call his office and say that he needed to vote no on the original bill. So it's clear that Musk's reach, his constant posting on X yesterday, ultimately helped kind of stoke this fire that ultimately led to Trump having to put out this statement saying that he unequivocally opposed it, citing many of the claims that Musk had originally put forward, saying why he didn't like the bill in the first place.
Tyler, great reporting, as always. Tyler Kendall there down in Washington, D.C. The incoming president has got a tough job. You need a big psychological shift down in Washington, D.C. There is an addiction to spending that grips both parties. And we've seen that. You described it, the process of the last week or so. You're seeing that play out.
The problem is there is some spending that can be productive, but there is no overarching mechanism to look at what's productive and what's wasteful. And that's what people are hoping for. Whether that can be put in place is another story.
More on that story a little bit later. Coming up this hour, Ian Steely of JP Morgan on Fed Chair, Jay Powell.
the dirty little secrets of credit is that the businesses generally don't pay you back, right? The markets pay you back, M&A pays you back. So what is the most important thing is to always make sure that the borrower is worth more than the loan. And as long as the borrower is worth more than the loan, then it might be a rocky ride, but you're going to get your money back. And this world where there's these disruptive companies that have, let's call it 100, 200, 300 million of ARR, are looking to not raise equity capital because of the fact that they raised it in 2021 or 2022, and no one really wants a down round. But there's a lot of capacity in the capital structure to have, let's call it a structured solution. We think that there's a lot of opportunity with those businesses.
Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg's covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and an ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
The picture this morning, very different to the picture yesterday afternoon, bouncing back from some big losses across the board. Equity futures look like this. On the S&P 500, up by 0.4. On the Russell, the small caps, up by 0.4%. You saw the moves yesterday afternoon at the close, the biggest one-day drop since August on the S&P 500, since July on the NASDAQ, since June 2022. On the small caps, the Russell got hammered.
And what was the surprise? I keep going back to this. Why the big reaction? Was it simply because they took one rate cut off the table that the market was expecting for next year, now only 50 basis points of rate cuts? Was it the fact that there was clear confusion on the FOMC and dissent? Or was it the idea that this can no longer be considered the tailwind that everyone was hoping with the soft landing nirvana also of tax cuts and deregulation?
Coconuts don't just fall from the tree. Do you remember that?
Yeah.
Kamala Harris would talk about the context. Got to talk about the context. Let's talk about the context. Don't know why I found the need to throw that in.
No idea either.
But let's talk about the context.
Let's go with it.
It's important.
Yes.
This meeting failed because of what happened at the November news conference. My take is that his approach to the November news conference set them up to fail at this one when they had to produce forecasts this time around. And this is why. In the news conference, he comes out in November and says, we don't assume, speculate, we don't guess. Easy to say on November 7th, shortly after the election, when you don't have to produce a forecast. In December, you have to produce a forecast. And it's obvious. So you ask the question, did you assume, speculate, did you guess? And he had to come out and say that some people did yes. How much of the change in the forecast was about Trump? How much of the change in the forecast was about the data? And the lack of conviction explaining as to what was what, I think underpinned the confusion for much of that press conference yesterday.
Especially because it was not clear that he understood that either. At a certain point, this is a confusing moment, and I think that you're right. If in November he had come out and said, look, we honestly are in a black box right now. We need a month or two to really settle out and to understand what the implications are. And right now, each member's dealing with it the way that they can, and I'll get back to you. That might have been a more honest answer. The difficulty is, this is not going to be a market that he can please because it is a market that is splintered also, and he, trying to give clarity, actually muddied the waters at a time where it's clear they don't have an upper hand.
He was burdened by what has been in the bond market. 2-year yields lower by 3 basis points. Nice. 432.28 on a 10-year. Yields up again by 2 basis points. The 10-year 453.41. That move on 10-year yields continues. That move on 30s continuously. So yields are up.
At a certain time that people are talking about, if you are concerned in revising up inflation expectations, then why cut it all? And that was the ultimate question that was not answered in a way that gave this market satisfaction that they were actually committed to tamping down inflation going forward.
With those high yields, Bramo, you know what happened in foreign exchange. Yields up, dollar stronger, the best performance for DXY since the post-election rally in the immediate aftermath of the Donald Trump win, closing at its highest level, I think, so far this year for DXY. Dollar yen, the move extends. We're up another 1.4% on dollar yen, 157, because the Japanese aren't ready. to hike interest rates again over at the BOJ. So that stretch, that rubber band, just stretches even more.
Yeah, and there was one dissent among the 9 members on the Bank of Japan with saying maybe we should raise by 25 basis points. But again, this raises a question of how much some of these other central banks are going to have to respond to the strong dollar, more than maybe concern about weakness or not enough inflation if you're the likes of Japan.
Dollar yen, 156.95. Under surveillance this morning, President-elect Donald Trump opposing the proposed funding bill on Capitol Hill, threatening to oust fellow Republicans if they accept legislation that doesn't include his demands. This coming just days before funding is set to expire. The fun and games begin in Washington, D.C.
Is this fun?
It is not fun.
It is games.
It is certainly a game.
Well, this to me is a real question of just functionality and what can actually get done. And it highlights what Anne-Marie's been talking about all year, which is the narrow majority in Congress, despite the fact that the Republicans do have a majority. A real question of how much consensus you can get and what role Elon Musk plays. I keep going back to this. Elon Musk, the Doge taskmaster, came out and basically said, no way, no more spending, stop it with the raises. And then Donald Trump came out and said it too. How much is he going to be setting the tone for what gets passed and what doesn't?
Or maybe he's just part of the attack dog team. We've got to pick one here. Got to be consistent about this. A few weeks ago, you had Democrats coming out and saying he's got no power, Doge doesn't do anything. A few weeks later, he's got all the power, he's the sitting president. Which one is it? How much power does Elon Musk actually have?
Can't we have both?
I would say something in between. I think he has great influence, but he has limited power.
Sure, and I think that that's the case probably for most people in Washington, D.C. Look, it is a stew, and I'm going to take a note from what I just criticized Jay Powell for saying, which is I'm not going to say with any certainty who has power and who doesn't, because ultimately, for as long as he's first buddy, he could have a lot of power in deciding what President Trump decides to say and how he decides to put his thumb on the scale with other Congress members.
Think about it like this. What's the president threatening to do? Primary people who don't come along with him. How do you primary people? You need some money. Where does the money come from? A lot of that money at the moment is coming from Elon Musk. So he's kind of like put this picture together. That's how this is working.
So you're falling in the all the power camp?
No, I think power and influence is combined and money's behind that. That's what underpins it, and that's why Elon Musk has so much influence at the moment.
Bottle it. I think that we'll have to just keep going back to that.
I don't think that makes him the sitting president. I think that's very, very different.
I didn't say he was a sitting president. Let's move on.
Okay, we can move on to the BOJ. The Bank of Japan holding interest rates steady. The yen weakening after Governor Ueda said the central bank needs more information on Japan's wages and Trump policies before making a rate hike decision. He's not the only one now waiting. We've got policymakers worldwide who are hesitant to make moves because they're waiting to see what happens with policy in Washington, D.C.
Yeah, but the market's moving anyway. And this is sort of the key question. And at 7 a.m., in about 25 minutes' time, we get a decision from the Bank of England. On to you, the ECB, later on when they meet next. How much does the currency depreciation in their regions affect how much they can cut rates, even if their economies might need it? And their economies are still existing, despite the uncertainty that we might see elsewhere.
More yen weakness off the back of that call earlier this morning. Elsewhere, Volkswagen and union leaders moving closer to a labour deal that would keep German factories open. Sources telling Bloomberg management is willing to keep plants running and reinstate job security agreements until 2030 in return for workers foregoing bonuses. I'm not sure that's going to get it done with shareholders. This stock is down by more than 20%. This industry is structurally challenged. That company has 650,000 employees. And you've got to do something to restructure. And as we're seeing, it's going to be really difficult to do that over in Germany.
And if they don't, what does that mean in terms of job cuts? And when is the sort of relief lever coming from government? Oh, yeah, that's right. The government is in a complete disarray and isn't necessarily have any sort of cohesive center. So this is the issue. They need some sort of policy relief at the top and governmentally in order to stave off some of these closures. Otherwise, you have to imagine that those layoffs are going to continue.
Germany's an odd one. You've got all these countries around the world looking for fiscal space, and they can't because the market won't give it them. In Germany, they're looking for fiscal space, but they can't because it's self-imposed. It's kind of odd, isn't it?
Well, it's very emotional, and it goes to sort of this incredible sociological study, which is actually fascinating, and I plan to do it in my free time.
Let's get back to the Federal Reserve, and Lisa can continue doing that in her spare time and maybe in the next commercial break. The Fed making a predicted 25 basis point rate cut at their final policy meeting of the year. Ian Steely of JP Morgan saying the Fed's decision to step to the side and slow the pace of rate cuts makes perfect sense. Having lowered their policy rate by a full percentage point from its peak, they can afford to be more cautious in considering further adjustments. Ian joins us now for more. Ian, welcome to New York and good morning.
Morning.
What changed yesterday afternoon for you?
I think you're in an environment where, and this is the problem that Powell had during the press conference, They just don't know. Like I think Lisa said it, you've got dissenters, you've got some people putting an expectation of some form of tariffs into the forecast, you've got some not. There's just a lot of uncertainty. Everyone's got a lot of uncertainty at the moment. They're struggling with an environment where inflation has been a bit more sticky than they would have hoped for. They've had to raise all their forecasts. Growth's been a little bit stronger than they were expecting. They've raised all their forecasts. So it just makes sense to take a pause, take a break. They've done the 100 basis points they basically told us they were going to do in September. That's been forced through. It's happened. Now we're going to step back. Let's wait for the January meeting, go through that. We'll have more sense in March as to what the administration is going to put into play.
What is the price of that uncertainty, of lower conviction at the Federal Reserve? Is it higher yields at the long end or lower yields at the long end? Which one is it right now for you?
I think the initial reaction is what we've seen is higher yields at the long end. Now, if we did just start to get to an environment where actually the data started to look a little bit more dubious, and we were still uncertain that the Fed was going to react because they were possibly concerned about what the inflation expectations were in tariffs, then the long end is going to get a bit of a rally. But for the time being, I think we're looking at people who are just a bit concerned. We're not completely sure what's going on. And actually, the US economy is just doing better than had been thought.
I guess I'm confused why this isn't just making the long end a raging buy. I would actually think that this would actually make the bond market on longer duration more attractive if you have a Fed that seems to be suddenly no longer biased to cutting, is actually in the mood to fight inflation, considering the fact that this is a Jay Powell that really highlighted how surprised they've been from the stickiness of inflation.
I guess you've got a couple of things. So it wasn't, what was interesting with the curve sort of moved up in parallel to some extent yesterday. So it wasn't as if people were focusing on one party. It was just a general move higher in yields. The Fed isn't going maybe as quickly as people had thought. We're still concerned about the fiscal side and what's happening on that. So it just means yields needs to be a bit higher. I think the big question to me would be how high can these yields actually go? And I think that's to your point. It doesn't feel like we're in an environment where we were last September. You know, the cash rate back in last September was 5.5. We were still expecting, or there's still a 50% probability of another hike. You know, we're 100 basis points lower today. The Fed is still on an easing path, even if it's going to be slower. So although we are seeing a bit of a move higher in yields, it doesn't feel to me at least that we're going to go to the levels we saw last September, which means when things do settle down and when cool heads prevail, there probably will be a lot of people thinking, actually, at these levels, you know, long-term strategic, the insurance you get from fixed income makes sense.
Going back to what John was asking, the risk premium and what you have to sort of bake in, that's sort of a new charge for the level of uncertainty that we see right now in the economy. I wonder if this makes credit less attractive on the margins, given the fact that companies are going to be evaluating the scene in the same level of uncertainty as the Federal Reserve and as economists and as traders.
I think from our standpoint, credit, the corporate fundamentals still look very strong. We're likely to get policy out of the administration that is credit and kind of corporation positive. We know that the administration is going to be looking at things like the stock market to decide whether they're doing a good job or not, and they sort of focus on things like that. To me, it's still a good environment from the credit side. Yes, credit spreads are tight, but the fundamentals are strong. I think the all-in yield's important.
Hold on a second. If maybe this is an administration that looks at the market and tries to make sure that the stock market is rising. And this is a Federal Reserve that watches the stock market rising and says that's froth, and actually is more inclined to keep rates higher, which sends the market lower. Who do you listen to more?
I'm not sure the Federal Reserve does look at the stock market, because the stock market's been going up, and they've continued to talk about tight financial conditions and things like the mortgage market. I think the administration does look at the stock market, so I think that's what we'll focus on.
January 10th, next payrolls report. Can this whole story just flip in the other direction again on one data point? Given the hypersensitivity of this FOMC to incoming information?
The market can definitely flip on that data point. I think you've got two things, because I think you do need to be jobs, but I think we've also heard that now inflation is back in the game. You know, we'd heard that inflation under control. We'd heard those comments during the summer that it was the labour market, the unwillingness to see the labour market deteriorate further. Now we've had that forecast from 2.1 to 2.5. Suddenly that's looking a little bit suspect. So I do think jobs is important, but I think we're going to be focusing on inflation as well.
Been whipsawed 3 times with seemingly no underlying assumptions about where this economy is heading. Is that unusual for a Federal Reserve chair?
I think it just shows the uncertainty we're in at the moment, and also it shows you how much the market can sort of drive the price action. Because actually, when you think about what did the Fed do this year, they had four cuts price, they went to 2, they went back to 4. It was the market that was at 7. It was the market that during April was saying, maybe we should be hiking again, and then it was the market that was back at 6. So the Fed's been a little bit more than the market. The market's the one that's been whipping around.
Ian Staley at JP Morgan. Ian, appreciate your time. Thank you. Lisa, as the point you made, the focus has shifted. The emphasis seems to be, relatively speaking, much more on inflation, and that's tempered the easing bias of the Federal Reserve, which has spooked this market a fair bit in the past 24 hours.
Yeah, to me, what stood out was his explanation of how concerned they were that inflation continued to surprise to the upside, and that was one of the reasons why they're rethinking just how quickly they are going to be cutting rates next year. The key question to me is, exactly to your point, John, what data points would it take for this FOMC to completely change its tone once again, for some of the FOMC members who might be in the minority this time to come into the majority?
Actually looking forward to the Fed speak going into the holidays.
Me too.
Looking forward to it over the next few days, that's for sure. If you are just joining us, welcome to the program. Equities attempting to bounce back from yesterday's losses, the biggest one-day loss since the summer on the S&P and on the Nasdaq. We're higher by 0.4% on the S&P 500. With an update on stories elsewhere, here's your Bloomberg Brief with Yahara Hackers. Hey, Yahara.
Hi, John. The Supreme Court agreed to hear TikTok's challenge to a law that could ban the app in the U.S. if it's not sold by its Chinese parent company. Arguments will be heard by the High Court on January 10th, just 9 days before the ban is set to take effect. TikTok and its parent company ByteDance claim the law violates free speech protections. Meanwhile, Bloomberg has learned that Apple is scrapping plans to build an iPhone hardware subscription service. According to people familiar with the matter, the idea was to make owning an iPhone like subscribing to an app, with consumers paying monthly fees and getting new phones each year. But the project was scrapped due to a number of setbacks, including software bugs and regulatory concerns. And Barclays is set to increase its annual bonuses by as much as 20% after an improved year for traders and investment bankers. Trading unit staff are expected to see a 5 to 10% increase, while bankers in debt and equity capital markets could get 10 to 20% more. This is welcome news for employees after last year, when dozens of bankers got no bonuses at all. That's your Bloomberg Brief. John?
20%. Yahara, thank you. Bob Michael, if you're listening, great job by Ian Staley just moments ago.
Yeah, you need real analysis like that to
in
really
town
keep
for the
going.
annual eval.
Yeah,
You know,
this is the great moment.
Find out the numbers in the next few months. Anyway, just throwing it out there, Bob. Up next on the program, Chair Powell changing his tune.
In the near term, the election will have no effects on our policy decisions. Some did identify policy uncertainty as one of the reasons for their writing down more uncertainty around inflation.
That conversation up next. Live from New York. You're watching Bloomberg TV.
In case you missed it on Bloomberg, The China Show.
What's been the sentiment? What's been the reaction to this U.S. election outcome on the ground?
They were pretty much ready for Donald Trump. There was a high expectation that he could return to the White House.
We have dealt with him before, and after quite a few years, China simply is better prepared, and China, psychologically speaking, is much more prepared than in dealing with him again.
Probably are fully prepared for Trump to impose higher tariffs on China.
What's the tone as they were talking to really a global investment?
Right. The openness of China, including the capital markets, Hong Kong being an international financial center, will be extremely important in channeling global investors.
Don't miss The China Show live every weekday.
David Weston,
Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's emissions.
Done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
As we spend some time here on the broader presidential race.
Let's focus in on European politics.
Makes you wonder how politics might play out.
Bringing you up-to-the-minute financial news whenever and wherever it happens. I'm Michael McKee at the Federal Reserve, and this is Bloomberg.
So much to break down and digest following that news conference yesterday with Chairman Powell. They cut 25 basis points, called it a close call, then basically delivered a news conference which was pretty consistent with hiking interest rates over the next 45 minutes.
Yeah, and said that it was a closer call, and at the same time, really not necessarily giving clarity onto what would necessarily cause them to cut rates or even potentially hike rates in the future, even though that was not a likely possibility.
Welcome to the program to all of you just waking up on the East Coast and to some of you waking up on the West Coast, which is incredibly early. Those of you over at PIMCO.
Go back to bed.
I don't think they can. Equity futures on the S&P right now bouncing back by 0.4%. In the bond market, yields higher by, let's call it 2 basis points. The 10-year, 453.41. Under surveillance this morning, Chairman Powell changing his tune.
In the near term, the election will have no effects on our policy decisions. We don't guess, we don't speculate, and we don't assume. Some people did take a very preliminary step and start to incorporate highly conditional estimates of economic effects of policies into their forecasts at this meeting. Some did identify policy uncertainty as one of the reasons for their writing down more uncertainty around inflation.
So here's the latest, what a difference a month makes. Fed Chair Jay Powell admitting multiple FOMC members weighed policy uncertainty in their economic forecast. Drew Mattis of MetLife focused on inflation, writing there remains a risk that inflation moves higher and, even if temporary, it may disrupt the Fed's path forward up to and including reversing course. Drew joins us now for more. Drew, welcome to the program, sir. We all had the same question when we saw the updated forecast. How much of it was about the realized data? How much of it was Trump? Drew, which one was it?
Well, I think to answer that, you have to look back to September. Why did they go 50 in September? And the answer is probably because they didn't want to have to go 50 right around the election. And then why did they go in November? Because they went 50 in September. And so now this is a little bit like, the woman who swallowed the fly. And they just keep trying to fix a situation and make it look like they're not political, when in fact they actually seem to be becoming political. Put another way, they're like my teenager driving a stick shift car. It's like jerking forward and then backing, sputtering around, and the car just doesn't function well when that happens, and that's the market response you saw yesterday.
So, Drew, what do you think they need to fix when they convene again at the end of the first month of next year?
I think they need to work on consistency. You cannot be cutting rates and hiking your inflation expectations for the next 2 years. How that got through and someone didn't point it out. In fact, maybe the most market savvy person on the committee did figure it out. And President Hammack dissented because, it didn't make any sense what they were doing. And of course, she came out of, an investment bank and would probably have a sense that markets weren't going to respond well to this kind of messaging.
I love your comment. If an alien lands on the planet having studied monetary policy, would they think the Fed needs to be cutting here? I just love the idea of aliens studying monetary policy. Drew, I am curious going forward about really how this can be a Fed that is apolitical, right? I mean, essentially, all economists have some sort of political bias or see the world in a certain viewpoint. Is there a certain metric? Is there a certain scenario analysis test that would give markets confidence that this was a Federal Reserve trying to strip out any political bias?
Well, yes, if you're going to raise your inflation call, don't be cutting interest rates, right? You've been missing your inflation target for quite some time now. People could kind of justify the idea of a very slow normalization of rate cuts or rates down to a level that's consistent with neutral, because there'd be lingering tightening effects going on. But it seems like they're rushing to get to that neutral level as opposed to just kind of letting them, they keep saying they're data dependent, but this doesn't seem like a data dependent move. The data is telling them that maybe they're moving a little too fast, and they're like, well, no, we have to keep moving. So that they've pre-committed to a course of action, and it got them in trouble yesterday.
You said the market is not the Fed's friend, and I wonder how you believe the Fed will look at the market action, why that in some ways doesn't even help them, because on one level, this is maybe what they're looking for to reduce some of the potential inflationary pressure.
Maybe, but I think if we take a step back and we say, okay, the Fed was decided to cut rates, did they really want tens to behave the way they did, and the impact that that'll have on the housing market? Have they made the economy stronger or weaker by cutting rates yesterday? And I think the answer is they probably made the economy weaker. They haven't done anything to contain inflation issues. And people are rightly, I think, concerned that they're not being consistent. And it's very hard to read an inconsistent Fed and determine where policy is going to go. Torsten Slok's out there saying they're going to potentially hike rates next year. I've got some sympathy for that view. I don't have a lot of sympathy for a view that they're going to be able to cut rates more aggressively, or that they might even be able to get back down to neutral now. Sometimes if you run too fast at the start, you can't finish the race that you wanted to finish.
So, Drew, this raises a big question about markets, so let's finish on that. People were bullish, very bullish, going into 2025. The average forecast on Wall Street for the S&P year-end next year was north of 6,600. Drew, do you think now that we're compromising the easing bias of the Federal Reserve, now that policy is increasingly uncertain going into next year, there's a reason to start leaning in the other direction? Or do you pick up the pieces from yesterday and keep running with the bull?
I mean, I think there are hints that growth are fine. There's also hints that growth are weak, right? And it is weak. I would say on balance, it still suggests the economy still looks like it's in pretty good shape moving forward. But at the same point, it was already kind of a questionable kind of, how much risk do you want to take to get the returns that you're probably going to expect? And I think people have probably dialed up the risk that's going to occur, and they've actually dialed down the returns that they can expect. And so I think we're seeing that dynamic play out.
Drew, appreciate your time, sir. Thank you. Drew Mattis there of MetLife Investment Management. I think most equity strategists would tell you we can handle rates at this level so long as growth is pretty decent. But if the problem is something else, if that something counts as inflation, then that's a little bit more toxic, to use a word that you enjoy.
Well, it's a toxic brew if you have inflationary pressures that are a bit too strong and a Fed that pre-committed to rate cuts that some people view as a potential policy error. We now just have two people on the show really hinting at that, given the fact that this seems to be a market with renewed concerns about lingering inflation. Again, the fact that they cut rates and then increased next year's inflation expectations was really a shot across the bow to markets that had gotten maybe a little bit over exuberant.
Silver lining, market pricing, given where it is, they've got some optionality that maybe they wanted for 2025. I would say this, though. Adam Poston came out earlier in the summer, said start trying to find that optionality right now for a very uncertain 2025. Adam Poston on a program with Manis a little bit earlier making the same point. Up next on this program, Savita Subramaniam of Bank of America, Bloomberg's Mike Shepard, former Kansas City Fed President Esther George, and former House Majority Leader Eric Cantor. A Bank of England rate decision also just around the corner.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything.
It'll be easy, but at least there's a theory of change.
The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have Take-Two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything. From the world of politics to the world of business, Joe Matthew and Keely Lines deliver news, insight, and analysis live 2 times a day every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. It's the world's second largest economy with a growing influence in global affairs. But geopolitical uncertainties, deflationary pressures, and questions about foreign investment linger. Bloomberg, The China Show, brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China. Bloomberg, The China Show. Weekdays around the world right here on Bloomberg. Context changes everything.
The Federal Open Market Committee decided to take another step in reducing the degree of policy restraint by lowering our policy interest rate by a 1/4 percentage point.
They still believe that they were restrictive and that even with a 25 basis point cut, they maintain that level of restriction.
I actually think they did the right thing. I'm pleasantly surprised they went to 2 cuts next year.
We're not seeing a meaningful dialing back of policy in the months ahead.
They're signaling a pause, but it's also important to remember that by March, the forecast might look a little bit different.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowitz, and Anne-Marie Hordern.
The second hour of Bloomberg Surveillance starts right now, and your scores look like this on the S&P 500, attempting to bounce back. Equity futures up across the board on the S&P 500 this morning, positive by 0.5%, following the biggest one-day loss since August on the S&P, the worst Fed day performance going back 20-plus years. On the Nasdaq, the biggest one-day drop going back to July. On the Russell, the worst day of the year so far. Russell equity futures up by 0.5%. If you switch up the board and get to the bond market, 2-year, 10-year, up by more than 10 basis points in yesterday's session. We're up to 432 on 2s. On 10s, we had some weight to the move, up another basis point, 452.41. The Federal Reserve reducing interest rates by 25 basis points. They called it a close call. They changed the forecast. They give inflation a hike. They dropped the median dot for 2025 from 4 cuts to 2. And people asked them in the news conference, why are you cutting interest rates at all at the Federal Reserve? Is it about the data? Is it about the incoming administration? They seem confused about 2025, and apparently they're not the only ones. Over in England, in London at the central bank, just deciding to keep rates unchanged, and Governor Bailey saying we can't commit to when or by how much to cut in 2025.
It is a black box. It is a dark room with lots of furniture. People are moving slowly. It is the U.S. It is also the Bank of England. After you saw wage growth that came in a bit higher than expected, Andrew Bailey is saying gradual approach to future cuts remains the right approach, and that seems to be the new zeitgeist for 2025.
Let's head out to the City of London and catch up with Guy Johnson for more on this rate decision. Guy, the vote 6-3 to keep rates unchanged at 4.75. Just how close was this one, and how disrupted was it by this week's data?
So Ramsden and Taylor have joined Dingra in calling for the cut. That's where the surprise comes, John. If the Fed delivered a hawkish cut yesterday, in some ways this is a dovish hold from the Bank of England. Rates are remaining on hold, but you've got a vote split that suggests that actually there was a lively debate about whether or not that cut should have been delivered. Bailey talks about a gradual approach remaining the right course, but they are downgrading the growth picture. They talk about the wage story being, or the labour market being largely in balance. You can see what is happening to the pound right now, giving back some ground that was gained a little bit earlier on against the US dollar. The market going into this decision was actually fading moves for 2025. I wonder whether or not that, as with hindsight, will prove to be the right decision. So we are now seeing, traders adding to bets of easing, sees 58 basis points of cuts next year. So that's a slight tick up in terms of what is anticipated. But the UK faces a very different picture to what we're seeing in the United States. John, growth here is weak. Inflation remains sticky. That's a really difficult course to navigate for the Bank of England going forward. A hold today, but feels a little bit more dovish.
Central bankers seem to be scarred by their recent history. I wonder, Guy, how much the reason why they didn't cut was fear of a Liz Truss moment at a time where the UK faces a bit more weakness than, say, the US.
The UK certainly does face, Lisa, a lot more weakness than the United States. If you look at the growth trajectory going forward from here, like on different planets right now. The latest budgets, I think, from